This video is related to CMA final group 4 students who are appearing for the December 24 examinations, and this video is about corporate financial reporting marathon. So welcome to BCCA, and I am your CFR faculty CR Kumar. So in this marathon we have covered 4 chapters. So business combinations and internal reconstruction, consolidated financial statements and separate financial statements, and recent developments in financial reporting, and the fourth one is government accounting in India. So these 4 chapters will put together will give you at least 60 marks. So these are the analysis from the past 3 examinations. So in June 24 63, and December 23 63, and June 23 60. Sir, what is the duration of this marathon, sir? The duration of the marathon is 6 hours. By investing of 6 hours, you can get at least 60 marks. Then, coming to business combinations and internal reconstruction. In 5A question, in June 24, business combination question will be there for 14 marks. In December 23 also, the question is coming from business combinations only for 14 marks. So what about 4P? The internal reconstruction question is coming from 4P. The 4P question is coming from internal reconstruction for the last 2 attempts for 7 marks. So internal reconstruction 7 marks and the business combinations 14 marks in 5A. Next trend 6A. Consolidated financial statement. 6A question is coming from the consolidated financial statements for 14 marks. Let's initiate our discussion with business combinations and internal reconstruction. What is meant by business combinations? Business combination means it is a transaction or an event in which one company gains the control of another company. It is called business combination. There are 2 types of business combinations. So in first one, there is a change in control. In second one, there is no change of control. So let's understand this with an examples. Come to example 1. Pushpa Limited taken control of Srinu Limited. So it is a business combination. I need to check for the control, whether the control is changed or not, for the classification of business combination. Here, Srinu Limited is controlled by Mr. Srinu before acquisition, but after acquisition, the control is changed from Mr. Srinu to Mr. Pushpa. So it is a business combination and there is a change of control. So this is first type of business combination. Second example. Pushpa Limited created Srivalli Limited and transferred its business. So this is the behind story. Just I am giving for the understanding purpose. So now what Srivalli Limited is doing? Srivalli Limited taken over control of Pushpa Limited. So it is also satisfies the business combination definition. Next, Pushpa Limited is controlled by Mr. Pushpa before acquisition. After acquisition also, the control is lies with Pushpa. So there is no change of control. So control is not changed from Mr. Pushpa. So this is called second type of business combination. In second type of business combination, no change of control. So we will also call it as common control or external reconstruction also. In first type, there is a result in change of control. There are 3 types of business combinations in this result in change of control. First one, taken over or absorption. Second one, acquisition by shares. In acquisition of shares, there are other 2 subdivisions. Normal acquisition will be there and reverse acquisition will be also be there. And third one, legal acquisitions. So for this, there are few examples. Let's understand this also with an examples. So takeover or absorption. What is meant by takeover or absorption? In takeover or absorption, the acquiring company is terminate its business. In our example, Mahesh Limited acquired Namartha Limited. But after acquisition, Namartha Limited terminates its business. So there is no continuation of business. then this business transaction has to be recorded in Mahesh Limited books in separate financial statements. So there are two types of financial statements actually, separate financial statements and consolidated financial statements. For the consolidation purpose means in acquisitions we need to combine two financial statements. In that case I need to use the consolidated financial statement. Here for consolidation purpose there is no separate financial statements will be available for Namarta Limited. So here only SFS is only available. So the business combination transaction has to be recorded in SFS of Mahesh Limited in case of business combination in takeover or absorption. And come to second one. It is the acquisition of control by shares. So how we can say that there is a control? There is a deemed assumption. If you acquired greater than or equal to 50% of shares, then there is a deemed assumption that we can get the control unless otherwise specified. Then in this example, Chaitanya Limited acquired Samantha Limited. So the control is obviously transferred to Chaitanya Limited. But here Samantha Limited continued their business and Chaitanya Limited is also continued their business after acquisition. But for the consolidation purpose, for recording this transaction, Chaitanya Limited should record in consolidated financial statements, not in separate financial statements. We should record this transaction in consolidated financial statements in Chaitanya Limited books. So in Chaitanya Limited books, they should prepare SFS as well as CFS. In CFS, we should record this transaction because there are two SFS are available. Why? Samantha Limited doesn't discontinue their business. Samantha Limited is continuing their business, but the control is lies with Chaitanya only. But in this case, Namarta has terminated its business. There is no separate financial statements for Namarta business because there is business is not at all existing from now onwards. So this transaction has to be recorded in SFS in the first case. Then come to third one. Legal acquisition means it's not much important. It's like acquisition by the order of the court or government or tribunals. Then come to acquisition method. What I am saying, there are mainly two types: result in change of control and no change of control. If it is result in change of control, the Ind AS 103 will deal with this accounting treatment by using acquisition method. The second one is there is no change of control, means common control. So it is dealt by Appendix C by using pooling of interest method. Then what is meant by acquisition method or pooling of interest method? We will discuss later. Before going to that, there is an illustrations with regard to takeover and acquisitions. So this is an acquisition method. We will discuss it later. So first we will see the example for takeover. So A Limited takeovers B Limited for 12,60,000 rupees and fair value of B's net assets at the time of acquisition amounts to 11,80,000 rupees. So calculate goodwill and journal entries in the books of A Limited. A Limited is called acquirer and B Limited is called acquiree. So this is an example for takeover or acquisition. What happened in takeover or absorption? In this, B Limited will cease to exist. Why? Because B Limited is discontinued their business. B Limited will not continue its business because it's a type of takeover. It has taken the company. It's all take over the entire business. So B Limited will discontinue their business. So the journal entry in the books of A Limited should be recorded in separate financial statement because there is no question of SFS. If two SFS will be available, then CFS need to be prepared. Here there is no SFS for B Limited. So the transaction is, sorry, the journal entry in the books of A Limited in separate financial statements as per Ind AS 103, because there is a change of control, right? So Ind AS 103 deals with this. So net assets, how many net assets? 11,80,000 fair value of net assets. Goodwill is the balancing figure to purchase consideration. So this is the what we are getting, this is what we are paying. So we are paying under 12,60,000 in the form of, I think, cash. Is it mentioned in the question? Mentioned, what he mentioned? So take our P Limited for 12,60,000, I assumed for cash. So I paid 12,60,000 rupees for the net assets of 11,80,000. So I paid more. So the balancing figure is the goodwill. Then it is called acquisition by way of takeover or absorption. Then come to second one. What is the second one? Acquisition by way of shares. Even though if you acquired 100% shares, the acquiring company will continue their business. If they continue their business, they need to prepare separate financial statements. So parent company will prepare consolidated financial statements along with this respect to separate financial statements. So don't worry, let's understand with an example. So A Limited acquire 100% shares of B Limited for 12,60,000, same. Net assets value is 11,80,000. Now I need to find out the goodwill and I need to pass the journal entries in the books of A Limited and B Limited. So second one, it is an acquisition by way of shares. So I need to prepare CFS. So in A Limited books, there are two sets of books. So SFS and CFS. Here simply saying we are buying investments by paying 12,60,000 rupees, right? So in separate financial statements, investment account debit to cash account. As per Ind AS 109, it's a financial instrument. We will discuss it at later point of time. Now consolidated financial statements. So what is the journal entry? Same. Net assets account debit. This is the consideration we paid for it. This is the goodwill. So the same journal entry has to be passed in the books of A Limited, but in separate financial statements in case of acquisition or takeover. But this is an acquisition of shares. That's why we pass this journal entry in consolidated financial statements. Then here 100% is there. So we acquired 100%. So what if we acquired 80%? So here changed the sum. So here acquires 80% of shares for 12,80,000 and fair value of B Limited net assets at the time of acquisition amounts to 14,80,000. Here one new word is coming. Non-controlling interests are recognized at fair value. Non-controlling interests are recognized at fair value. So what is meant by non-controlling interest? So first we will discuss what is meant by acquisition method, because acquisition method is used when the acquisition through shares. Here, for example, if you acquired 80% of shares of another company, I need to find out the purchase consideration. What is the amount of purchase consideration I have to pay for acquiring this 80% shares? Then after that, I need to use the word NCA. So we don't know what is the NCA. As per the acquisition method, so I need to record all the assets and liabilities of Acquirer Limited in the books of Acquirer Limited at fair values. So I am recording 100% of all the assets and liabilities in my acquirer books. But how much I bought actually? I bought only 80%, right? So that's why. But I am recording 100% assets. So that's why I have created one extra liability. So by creating this extra liability, then it equal to 80 rupees, right? For example, on balance sheet is right. Instead of writing on balance sheet is there, instead of writing 80 rupees in the asset side, I am writing it as balance sheet, asset side 100, liability side 20. So net balance is 80. So I recorded this 80 in such a way that I recorded 100% assets and I created extra 20% liability. In this case, net effect is I recorded only the extent of 80%. So this is the mechanism we followed in Ind AS 103. In this is called non-controlling interest, because we cannot control this percentage. To find out this value, there are two methods: fair value method and proportionate net assets method. What is meant by fair value method? In fair value method is also known as full goodwill method, and proportionate net assets method is known as partial goodwill method. How to find out the fair value of the goodwill? If fair value of equity share is given, fair value of equity share is given in the question, I need to follow this one. So how many number of shares for this 20%, I need to find it out. So NCI shares into fair value of equity of the share. Then if fair value of the share is not given, fair value of equity share is not given, then I need to use this formula. What is this formula? Purchase consideration divided by what is the amount, or sorry, what is the extent of percentage we have acquired. So 80% into what is the NCA percentage? 20. So purchase consideration divided by, so acquired percentage into 20. So this is the method for calculating fair value of NCA. Then come to second method, proportionate net assets method. In this, identify net assets divided by 100% into NCA percentage. So this is also called partial goodwill method. And come to this one. So purchase consideration plus NCI minus identified net assets will result into plus or minus. The absolute figure is plus, then we need to call it as goodwill. If the resulting figure is minus, we need to call it as gain on bargain purchase or capital reserve. If we know the clear reason, we will call it as gain on bargain purchase. If no reason is there, we need to call it as capital reserve. In one of your illustration, they are mentioned it as an capital reserve. So don't worry. Sometimes they have taken one assumption there. So there is they don't know the proper reason for this. So that's why they have taken capital reserve. So we can use both the words GBP, gain on bargain purchase, or capital reserve in acquisition method. We can use it simultaneously. But if you want to write one assumption, you can write it on over there. Then come to goodwill. There are two types of goodwill. If you follow the fair value method in the calculation of NCI, the resultant goodwill is called full goodwill. If you follow the proportionate net assets method, then we will call it as partial goodwill. Partial goodwill means the entire goodwill is related to the parent company only. There is no share of NCA in this goodwill. But in full goodwill, so this is shared between the parent company and NCA shareholders. So, but in, sir, what is the share of parent limited and what is the share of NCA? So here is the calculation. So parent company limited means by following partial method, I can find out the partial goodwill. So allocate that partial goodwill to parent. And how to arrive the NCA share? Already we know the full goodwill. Full goodwill is A, and deduct the partial goodwill from full goodwill, then we will get the share of NCI. So we are going to use this calculation in one upcoming problem. So this calculation will coming in upcoming problem. So this sum has been given in the last exam. So that's why I am stressing over here. Then, so this is the acquisition method. Then come to pooling of interest method. When we can use the pooling of interest method? In common control transaction. What is meant by common control? There is no change in the management control. The company is controlled by the same person before and after acquisition. So in this case, I need to use the pooling of interest method. This purchase consideration minus identified net assets equal to some goodwill or capital reserve, depends on the arriving figure. So how do I need to arrive the identified net assets? So carrying value of all the assets which are there in the acquiry balance sheet. Then carrying value of all the liabilities in acquiry balance sheet. But here I am not mentioned the acquiry balance sheet. Here I use the word taken over assets or taken over liability. I will differentiate the between both the methods at later. So currently just observe it how I am finding out the INA. Here I am using the words fair value of taken over assets minus fair value of taken over liabilities. Here I am using the words carrying value of all the assets and carrying value of all liabilities in acquiry balance sheet minus other equity. And come to the difference between the acquisition method and pooling of interest method. So acquisition method is dealt by Ind AS 103 and pooling of interest method is dealt by Appendix C of Ind AS 103. So there is an appendix and annexer attached to the Ind AS 103. So the accounting treatment of pooling of interest method is dealt given by Appendix C. Then consideration of assets at fair value. In acquisition method, the consideration of assets in the form of shares, cash, whatever it is. So most of the times the consideration should be valued at fair value. In this case, here the consideration is discharged in the form of shares. So the consideration is calculated by using nominal value of the shares. Come to, we should recognize that taken over assets and liabilities at fair value. So what is meant by taken over? Some assets will not be recognized in acquiry books. So it might be shown in the notes to accounts. Even though it is shown in notes to accounts, acquirer can record those assets and liabilities in acquirer books. Okay. So recognize taken over assets and liabilities at fair value, even though those taken over assets and liabilities are not recognized in acquiry books. Not recognized in acquiry books means it is not showing in balance sheet. Come here. Recognize assets and liabilities and other equity also. Not only assets and liabilities, we should record other equity. But don't write the equity share capital of acquiry company, okay? So record only other equity, yet book values and assets, liabilities and other equity which are recognized in acquiry books, means which are there in the acquiry balance sheet. Those assets and liabilities and equity only we need to take into our books. And come to example 3. So don't worry, this is the basic theory. We can get the better clarity by solving the sums. Illustration 1C. So A Limited acquires 80% shares of B Limited for 12,80,000. So the fair value of B Limited net assets at the time of acquisition amounts to 14,80,000. So non-controlling interest recognized at fair value. So A Limited is paying 12,80,000 rupees for acquiring 80% of shares. In return, what we are getting? We will get net assets. So I need to find out the fair value of net assets. Net assets means assets minus outside liabilities. So here afterwards I am using the words identify net assets INA. For non-controlling interest I will use the word NCI. Then this is the format for the calculation of the goodwill. So purchase consideration 80% is 12 lakh 80,000. So NCA is 20%. In question they are asking NCA calculation at fair value. So what I told to you in acquisition method, if I need to check whether fair value of acquiry share is given. If acquiry share is not given, then I can go for this method, PC divided by acquired percentage into NCA percentage. So in this they haven't mentioned anything about the fair value of acquiry company, that is B Limited. So that's why I will follow the second one. So NCA fair value method, 12 lakh 80,000 divided by 80%. 12 lakh 80 divided by 80% into 20%. So that can I get the 3 lakh 20 minus INA 14 lakh 80,000. Goodwill is 1 lakh 20,000. So in A Limited books I need to pass the journal entry, right? So what is the journal entry? I need to prepare two sets of books, separate financial statements and consolidated financial statements. Why? Because it is an acquisition of shares, not takeover or absorption. So in SFS it's just like we need to treat as an investment in B Limited, 12 lakh 80,000 to consideration. Here net assets, I need to record all the net assets at 100%, and I need to record the goodwill. Goodwill is the balancing figure to consideration. This is the amount I have paid, right? So to NCI. In liability side, in other equity, we need to show it as a separate line item, non-controlling interest, because I created extra liability, right? Then how to find out the NCI? By using fair value method, by using proportionate net assets method. So 12 lakh 80 divided by 80%. 12 lakh 80 divided by 80%. In proportionate net assets method, 14 lakh 80,000 divided by 100% into 20%. Then we will solve some difficult problems. Then you can get the clarity, like it will cover the so many transactions. So it will be useful for you. It will be helpful for you if you solve that kind of sum. The balance sheet of Professional Limited and Dynamic Limited as of 31st March 2002 is given below. So they are given separate financial statements of two companies, Professional Limited and Dynamic Limited. This is the balance sheet. So this is other information. Let's start with other information. Professional Limited acquired 70% of Dynamic Limited on 1st April 2002. So what is the percentage? 70% of shares on 1st April 2002 by issuing its own shares. So the consideration is in the form of own shares in the ratio of 1 share of Professional Limited for every 2 shares of Dynamic Limited. If you Dynamic Limited, for example, if Dynamic Limited has 2 shares, the Professional Limited will issue 1 share for the consideration. Then the fair value of shares of Professional Limited was 40 rupees per share. So what is the fair value of Professional Limited? 40 rupees. In this case, who is the acquirer? Professional Limited, because Professional Limited gains control over Dynamic Limited. So this is the business combinations, first model, and the next, it is an acquisition by way of shares. So I need to use the acquisition method. So in acquisition method, I want purchase consideration, I want identified net assets. Identified net assets what? Fair value of identified net assets. Then I got the information here which will be useful for calculation of PC. So I will put it as a PC. Then this is also useful for PC calculation. Then the fair value exercise resulted in the following. fair value of PPE on 1st April 2002 was 350 lakhs. So fair value of PPE on 1st April 2002 was 350 lakhs, which will be useful for in INA calculation. So INA, identified net assets. How we need to arrive the identified net assets? In fair value method, sorry, in acquisition method, fair value of taken over assets minus fair value of taken over liabilities. Then here they are giving furthermore information regarding with the consideration. Professional Limited also agreed to pay additional payment as consideration, that is higher of 35 lakhs. This is called contingent consideration because there is some ambiguity regarding the payment of the consideration, and as well as they inserted an element of deferred part also. So this is the combination of contingent consideration and deferred consideration. So higher of, what is the payment? Higher of 35 lakhs and 25% of any excess profits. They will provide higher of 35 lakhs at 25% of any excess profits in the first year after acquisition over its profits in the preceding 12 months made by the Dynamic Limited, and the additional payment will be due after 2 years. So when they are going to pay additional payment? After 2 years, not now. So Dynamic Limited has earned 10 lakh profit in the preceding year and expects to earn another 20 lakhs in the future. So what is the excess profit compared with the previous year? Here they are giving excess profits, right? So they are earning another 20. So previous profits is 10. So the excess is 10 lakhs. So I need to compare with 35 lakhs. So sorry, 25% of 10 lakhs or 35 lakhs, whichever is higher, obviously 35 lakhs. So am I paying 35 lakhs today itself? No, right? So I need to do the present value for this 35 lakhs. Then come to third point. So this will be useful for in PC calculation. In addition to the above, Professional Limited also agreed to pay one of the founder shareholders a payment of 20 lakhs provided he stays with the company for 2 years after acquisition. So they are paying to the shareholders a payment of 20 lakhs. Why they are paying? They are asking us to stay within the company as employers. So I assumed that they are paying to the shareholders, but not in the shareholder capacity, but in the employee capacity. If the payment is made in the employee capacity, sir, how you can say that it is employee? Because they are asking to stay with us, the company, after 2 years of the acquisition. So I assumed it. We are paying them for retaining them as employees. So this is not PC. So this will not be useful in PC calculation. Next. Come to D point. Dynamic Limited had a certain equity settled share based payment award, original award. This is known as original award, and which was replaced by the new awards issued by Professional Limited. So Professional Limited accepted to pay the ESOPs to the employees who are working in the Dynamic Limited, because the control is changed from Dynamic Limited to Professional Limited, right? So Professional Limited accepted that I will pay the ESOPs to the employees, so you don't worry. So then, as per the original terms, the vesting period is 4 years, and as of the acquisition date, the employees of the Dynamic Limited have already served 2 years of service. So Dynamic Limited has given ESOPs option 2 years back. Already 2 years has expired today. Today the control is changed from Dynamic Limited to Professional Limited. So as per the replaced awards, the vesting period has been reduced to 1 year. So now what is the revised vesting period? 3 years. Because remaining is 2 years, but it has been reduced to 1 year. So the revised vesting period is, it becomes 3. Then the fair value of the award on the acquisition date was, the fair value of original award is 5 lakhs. The fair value of replacement award is 8 lakhs. So it is also useful for in PC, purchase consideration. I will tell you the mechanism, don't worry. Then come to Dynamic Limited had a lawsuit pending with a customer who had made a claim of 50 lakhs. So what is the claim amount? 50 lakhs. Am I need to pay the entire 50 lakhs? No. Their claim is 50 lakhs. But management reliably estimated the fair value of the liability to be 5 lakhs. This is called fair value of contingent liability. So I can record the contingent liability of acquiree in acquirer books. Okay, even though that particular item is not recorded in the balance sheet of acquiree, but acquirer can record those kind of transactions in our books at fair value. So I need to find out the fair value of contingent liability. Most of the times, no, not only most of the times, in all the cases, the fair value of the contingent liability will be going to be provided in question itself. Applicable tax rate is 30%. Why they are given tax rate? Why they are giving tax rate? Because for the calculation of deferred tax asset or deferred tax liability, then you are required to prepare opening consolidated balance sheet of Professional Limited as on 1st April 2002. Assume the 10% is the discount rate. Why they are giving discount rate? Because for the calculation of consideration, because this 35 lakhs will give in after 2 years, right? So I need to do the present value of this 35 lakhs. For the present, for doing the present value, I need to use the discount rate of 10%. So Professional Limited is there. I can take the data whatever required for the calculation of the sum. So Professional Limited acquired Dynamic Limited. What is the percentage? 70%. So what is the fair value of identified net assets? We need to find out it. But I have jotted the information of equity share capital and number of shares over here. So I can take it from the balance sheet. So in the balance sheet, what is the useful information for us? So this is the useful information. So share capital, equity shares of 100 each of Dynamic Limited and 10 each of Professional Limited. So Professional Limited face value share is 10 rupees only. For Dynamic Limited it is 100 rupees. The share capital is 500 lakhs for the Professional Limited, 400 lakhs for the Dynamic Limited. So how many number of shares? So 500 lakhs is the equity share capital, fair value 10, number of shares is 50 lakhs. In Dynamic Limited, 400 lakhs is the equity share capital and fair value is 100 per share. So number of shares is 4 lakh shares. Here the Professional Limited acquired 70% of shares. So how many shares? Total 4 lakh shares of Dynamic Limited. Out of this 4 lakhs, Professional Limited acquired 70% shares. Some Professional Limited is saying, I will pay 1 share in Professional Limited for every 2 shares I have acquired from you. So 4 lakh into 70% divided by 2 into 1. How many shares I am going to be issued? 1,40,000. What is the market price of the share of Professional Limited? It is 40 rupees. So I mentioned here, right? I can use it in the PC calculation. So shares, 1,40,000 shares I have issued in my Professional Limited into 40 rupees is the market price per share. So 56 lakhs. Then one more thing is there. This can be utilized in the calculation of PC. Deferred consideration. Sorry, it is a combination of contingent consideration and deferred consideration. So for the deferred consideration, I need to do the present value. So they are mentioned 35 lakhs and 25% of excess profits. So previous year 10 lakhs, current year, future year, they are going to expect 20 lakhs. So 20 lakhs minus 10 lakhs, excess profit is 10 lakhs. So 25% into 10 lakhs, 2.5 lakh or something, or 35 lakhs, whichever is higher is the consideration. So I will take 35 lakhs. Am I paying 35 lakhs today? No, after 2 years. So by using the discount rate of 10%, which has been given in the question, so 35 lakhs divided by 1.1 whole square. So I can get the 28,92,561. Come to fair value of pre-combination period share based payment, because 2 years has been served for the company of Dynamic Limited, right? So what I am doing now, Professional Limited is ready to accept the ESOPs offered by Dynamic Limited. So but out of 4 years, already 2 years has been served for the Dynamic Limited, right? Actually this payment is made by the Dynamic Limited, but the liability of Dynamic Limited has been paid by the Professional Limited. So this is also a kind of consideration. So I need to find out the what is the value of the consideration. So fair value of pre-combination period share based payments. It is the formula. What is the formula? Fair value of the original plan, not revised plan. Fair value of the original plan into number of years expired. So out of the vesting period, how many years has been expired? Mean how many years has been served by the employees for the benefit of the Dynamic Limited. So years expired divided by original or revised plan. Original years or revised years, whichever is higher. What is original, sir? What is original years? Means original vesting period or revised vesting period, whichever is higher. In my case, what is the fair value of original plan? 5 lakhs. Fair value of original plan 5 lakhs. 5 lakhs into number of years expired 2 years divided by 4 revised. What is the revised vesting period? 3 years. So I need to take whichever is higher. So I'm going to take 4 years. So the answer is 2,50,000. What is the total purchase consideration? The fair value of the assets. Assets in the form of shares, deferred consideration, pre-combination period, share based payment reserve. So don't look at this sum as a difficult one. So look it as a part. So you can get the chance of calculating fair value of pre-combination period SPP in MCQs or in 5 marks questions also. There might be the chance, right? So it can cover all the concepts. So that's why I am discussing over here. Then come to, so one part is over, calculation of purchase consideration. So what is the second part? Fair value of identified net assets. So calculation of fair value of identified net assets. So this is the format for the calculation of identified net assets, because they have mentioned the tax rate. In that case, I need to find out the deferred tax asset or deferred tax liability, depends on the case. So that's why I am following this format. So this is carrying amount or tax base. This is fair value. Simply saying, we can call it as, first column is tax base and second column is recorded value. What is the recorded value for the assets or liabilities? Here we are recording the assets and liabilities at fair value. That's why my recorded value is fair value. In common control transactions, the recorded value might be carrying amount, because we are recording at carrying amount there. So here in first column always take the tax base. Tax base means they are not in question, they are not specifically mentioned about the tax base. So I assumed it, our carrying amount is equal to tax base. So that's why I have taken 500. But here fair value, the fair value of PPE is given is 350 lakhs. So apart from this, remaining all assets are fair value equal to carrying value. So 350 is the fair value, 500 is the carrying value. I assume that it is the tax base. So 500, 350, what is the difference amount? 150. Then for the remaining all assets, carrying value equal to fair value. So tax base equal to fair value. So there is no difference between these two values. Then come to deferred tax asset. So this deferred tax asset will be calculated at the end of this particular calculation. Now come to liability side. How many liabilities are there? These are the liabilities. For the assets, I have taken the Dynamic Limited assets and liabilities value, except this. For this, they are given the fair value. And come to liabilities. Financial, long-term borrowings, long-term provisions and deferred tax. So 270, 35. Just to substitute over there. 270 and 35. And short-term borrowings, 100 and trade payables, sorry, 150, 300, 150, 300, because I need to take the values of acquiree, not acquirer. So apart from these liabilities which are given in the balance sheet, I will take one more liability. What was that? Contingent liability. So contingent liability. Where is the contingent liability? So Dynamic Limited has lawsuit pending with customer 50 lakhs. And the fair value of this contingent liability is 5 lakhs. So I am taking this in my balance sheet. So that's why I am using the words fair value of taken over assets or taken over liabilities. So fair value of contingent liability, fair value 5. What is the taxpayer carrying value? I assumed it is a 0 because in balance sheet we are not at all recorded, right? So the taxpayer is obviously 0. So 0 minus 5, 5. For the assets, if the difference amount is in positive terms, then it becomes a deferred tax asset. If it negative, then it is deferred tax liability. I'm talking about the assets. Come to liabilities. 0 minus 5, it becomes minus 5. If the amount is coming in negative terms for the liabilities, then it becomes a deferred tax asset. Okay. If it comes positive, it is deferred tax liability. Remember this simple trick. So by using this, so 150 is the difference amount. How I need to find out the deferred tax asset? Difference amount into tax rate. So 45 is the deferred tax asset. Come here. So here minus 5. For the liabilities, if it is minus, it is a deferred tax asset. So 5 lakh into 30% is 1.50 is the deferred tax asset. So what is the total deferred tax asset? 45 plus 1.50. So deferred tax asset is 46.50. Then what is the fair value of the net assets? Total taken over assets, total fair value of taken over assets minus taken over liabilities. So fair value of net assets is the identified net assets. So second step is also over. Then I need to find out the goodwill or capital reserve. PC 87.43. PC 87.43 approximately. And what is the tax base? Sorry, what is the INA? INA is fair value of identified net assets 516.50. 516.50. So what is the NCA? NCA is remaining 30%. Are they specifically mentioned anything regarding the uses of regarding use of method for calculating NCA? No. Then in that case, I can take the fair value method, or sorry, identified net assets method. They haven't mentioned anything regarding the NCA calculation method. So I assumed that NCA is calculated by using identified net assets method. So 516 divided by 100% into 30. So 154 point minus INA 100% is 516.50. Then we will get the capital reserve of 274.12. Then come to the journal entry in CFS, because it is an acquisition by shares, right? So the PC transaction has to be recorded in CFS of acquirer. So I am getting net assets. So debit 516.50 by paying PC 87.43. What is the NCA which has to be recorded on the liability side? It means I should be recorded in the other equity as a separate line item, and say 154.95 and capital reserve 274.12. Then how I am settling the purchase consideration? So by paying in the form of equity shares and SPP reserve and long-term provision. What is meant by long-term provision? This is present value of deferred consideration. So this is the journal entry. Then come to consolidated balance sheet. So what are the assets here? What are the assets? Come to the balance sheet. Here they are giving PPE 300 and 500 for the Dynamic Limited. But for Dynamic Limited, fair value of PPE is recorded. So given fair value of PPE is given in the question 350. So for this alone you need to take 350. Remaining everything I need to take from the balance sheet itself. Why? Because here fair value is equal to the carrying values. For the Professional Limited, I will take only carrying values only. For the consolidated balance sheet, for Professional Limited, who is the acquirer, I will take only carrying values. For Dynamic Limited, I will take fair values. But here, except for PPE, for remaining every assets and liabilities, the fair value equal to carrying value. So this is an assumption I have taken, because fair values of remaining assets and liabilities has not been given in the question. So what is the PPE of Professional Limited? 300. And fair value of PPE of Dynamic Limited 350. So remaining that 400 plus 100, 250 plus 150 for the financial asset, trade receivables, cash and cash equivalents, others. So I should simply include each and every part of assets of Professional Limited and Dynamic Limited. And I should record equity share capital. Originally equity share capital is 500 lakhs for the Professional Limited. So 500 lakhs is the equity share capital. I record only assets and liabilities of Dynamic Limited, not equity share capital and other equity. So this is 500 plus I paid purchase consideration in the form of shares to some extent, right? So how many shares I have paid? So 14 lakhs. So 514 is the equity share capital. Come to other equity. 8110 is the opening balance. 8110 is the opening balance of Professional Limited other equity. Then 154.95 NCI. NCI should be recorded in the other equity. So how we are getting NCI? So NCI 154.95. Along with that, capital reserve should also allocated to the other equity only. So 274.12. 274.12. Then securities premium will be there. What is the securities premium account? 42. By this journal entry, we can finish the balance sheet easily. By observing this balance sheet, I need to check whether each and every item has to be recorded in the balance sheet. So that's why please write down the journal entry, even though they are not asking in the question. So what is the securities premium? So 42. So securities premium is 42. Then SPP reserve is 2.50. SPP reserve is also recorded in other equity. Come to long term borrowings 250 plus 200 taken from the balance sheet. Long term provision 50 plus Professional Limited, 70 for Dynamic Limited. How we are getting 28.93? Sir, long term provision. Sir, what is meant by long term provision? Present value of deferred consideration I created with the name of long term provision. So I recorded in the balance sheet in the liability side. Then come to deferred tax liability. In balance sheet itself, they are giving the deferred tax liability for both the firms. Along with this, I should deduct 46.50 is the deferred tax asset created because of this business transaction. So what is the deferred tax asset? 46.50. So I need to net it off. So generally there should be no netting provisions for the any assets or liabilities in the Ind AS except this DTA. For the deferred tax asset and for the deferred tax liability, set of provisions will be allowed. Then come to short term borrowings. So both 100 plus 150. And trade payables 250 plus 300. All these figures I have taken simply from the balance sheets. Okay. Then contingent liability is important because you cannot find out in balance sheet because it is off balance sheet item. Even though it is off balance sheet item, you can record it in your books. So that's why contingent liability 5. So total 3230. Then so this is the problem for the normal acquisition. So this is the problem for the normal acquisition. Let's see what is reverse acquisition. Then we can solve the common control problems. So, what is reverse acquisition? With this illustration, we can solve both common control problem as well as reverse acquisition problem. So this problem covers both the concepts. So let's discuss this one. So AX Limited and BX Limited amalgamated from 1st January 2002. So a new company ABX Limited with the shares of 10 each was formed to take over the business of existing companies. ABX Limited is acquirer company. It has been formed for take over the AX Limited and BX Limited. In this case, there are two acquirees. So, how many acquirees? Two acquirees. Acquirer is ABX Limited, one acquirer. And come to summarized balance sheet. They are giving AX Limited balance sheet and BX Limited balance sheet. So, PPE 8,500, 7,500 rupees in lakhs. Sorry, rupees in thousands. So, current investments, inventories, trade receivables, and cash equivalents. These are the information given in the question. So the important part is equity share capital, and other equity. What is the equity share capital? 6,000 for AX and 7,000 for BX Limited. Other equity 3,050 for AX Limited and 2,700 for BX Limited. And come to further information. They are asking ABX Limited issued a requisite number of shares to discharge the claims of the equity shareholders of transferor companies. So ABX Limited is acquirer, right? So it needs to pay the purchase consideration to the acquiring companies, but it is paying the purchase consideration in the form of shares. But they are not giving the information regarding how many shares they have issued. Just they are mentioning requisite number of shares. So I need to find out what is the requisite number of shares. Then also new debentures were issued in exchange of the old series of both the companies. Apart from this, they are issuing new debentures by exchanging of their old series of debentures. Prepare a note showing the purchase consideration and discharge thereof and draft the balance sheet of ABX Limited. First assumption, assuming that both entities are under common control. So if it is common control, I need to use the pooling of interest method as per appendix C. Then come to second one, assuming BX Limited is larger entity and their management will take control of the entity ABX Limited. So what is the acquirer here? Generally ABX Limited. So before acquisition, BX Limited is controlled by BX Limited management. But after acquisition also, after acquisition of BX Limited by ABX Limited, still the control lies with the BX Limited. He is only mentioning that BX Limited is the larger entity. So it is reverse acquisition because the control is with the acquiring company instead of acquirer. So it is reverse acquisition. Let's solve how to. And they are giving further more information. Fair value of net assets of AX and BX Limited. So PPE 9,500, 1,000 and inventory 1,300 and 2,900. Fair value of the business is 11,000 and 14,000. So, come to this problem. First I will do the sum by taking the assumption of BX Limited is the larger entity, so taken control of ABX Limited. So this is the classic example for the reverse acquisition. So who is acquirer? ABX Limited. Who is acquirer is AX Limited and BX Limited. But he is saying that BX Limited has taken control of ABX Limited. So the control is with acquiree, one of the acquiree. So it is called reverse acquisition. So what is the accounting treatment for the reverse acquisition? I need to find out the percentage held by each company in the combined entity. So what is the fair value of the business? 11,000 and 14,000, which has been given in the question. Fair value of the business 11,000, 14,000. Then what is the value per share? What is the fair value per share? 10 rupees and 10 rupees. 10 rupees and 10 rupees. So equity share capital 10 rupees each. That's why they are taking 10 rupees. And how many number of shares will be there? 1100 shares and 1400 shares, because 11,000 divided by 10. So number of shares 1100. Total number of shares in ABX Limited 2500. 1100 share plus 1400 shares. So total combined 2500 in ABX Limited, because both the companies are combining and one company is formed to take over both the companies, that is ABX Limited. So percentage held by each company in the combined entity. So for AX Limited 1100 shares out of 2500. 1100 divided by 2500 into 100, 44 percentage. And come to BX Limited 1400 divided by 2500 into 100, 56 percentage. So who is getting more control here? BX Limited, because in the combined entity BX Limited holds more percentage. So indirectly ABX Limited will ABX Limited control is retained with BX Limited. So BX Limited acquired the control of combined entity. So BX Limited is accounting acquirer and AX Limited is accounting acquiree in this case. Who is acquirer? BX Limited. So who is accounting acquiree? AX Limited, because ABX Limited is formed just now, right now, right? So there is no balance sheet for the ABX Limited separately. So I assume that AX Limited is the acquiree and BX Limited is the accounting acquirer. Then, but legal acquirer is ABX Limited. Legal acquiree is AX Limited and BX Limited. But this is not the case here. I am talking about accounting acquirer. I assuming that BX Limited take over the control of AX Limited, and I will do the accounting treatment by keeping that assumption in my mind. Okay. Then what is the fair value of the business of BX Limited? 14,000. It has been given in the question. How many number of shares in BX Limited originally? I want how many number of shares originally there in BX Limited as per the balance sheet. 7,000 is the share capital divided by 10. 700 is the original shares. Please don't confuse. Please don't take number of shares from here. Okay. So it is just for the calculation purpose of calculation of percentage held by each company. Then number of shares 700. What is the market price per share of BX Limited? 20 rupees. 14,000 is the fair value of the business and the number of shares 700. So market price per share is 20 rupees. So percentage of shareholding in the combined entity 56 percentage. How you got this? In the first step 56 percentage. Then for 56 percentage the number of shares 700. For the 100 percentage, what will be the number of shares? 1250 is the number of shares should be there for the 100 percentage. So number of shares should be there after acquisition 1250 shares. Currently, before acquisition, how many shares will be there for the BX Limited? 700 shares. If BX Limited is issued 550 shares to the AX Limited, then the percentage of BX Limited will reduce to 56 percentage. So this is the percentage we found out in the first step. So number of shares issued by BX Limited is 550. How you got this 550 shares? 1250 for 100%. I need only 56 percentage. So 56 percentage 700 is enough. So I assumed it. BX Limited issued 550 shares to AX Limited for acquiring the AX Limited. So with this I can calculate the purchase consideration. All these transactions are not original. For the accounting purpose I am finding out by keeping the one assumption that BX Limited acquired AX Limited. So purchase consideration equal to how many shares issued for the purchase consideration? 550 shares into 20 rupees. Sir, whose market price per share? Acquirer. Who is acquirer? BX Limited. BX Limited market price per share 20 rupees into 11,000. 11,000 rupees is the PC. Then I need to find out the fair value of the net assets of AX Limited, because AX Limited is the acquiree, right? So assets taken over minus liabilities taken over. So fair value of the net assets 10,100. So I am just taking all the amounts from the balance sheet only. So I am taking all the amounts 8,500, 1050, 1250, 1800 and 450. 1800 and 450, everything is taken from the balance sheet. Then journal entry. What is the journal entry in the CFS of BX Limited? So net assets to purchase consideration. So remaining is goodwill. Remaining is goodwill 900. Here there is no part of NCI, because I assume that I have taken the entire shares of, because they haven't mentioned anything regarding the how many shares we have purchased of AX Limited. So I assumed it is like taken over of 100% shares. So consideration account debit to, how we are paying the consideration in the form of equity share capital. How many shares? 550 shares into face value 10 rupees to securities premium 550 into 10 rupees, because the market price is 20 rupees. So 5,500. So in the books of CFS, record BX Limited assets and liabilities at carrying values, because BX Limited is acquirer. Acquirer, I need to take the carrying values of assets and liabilities. For the acquiree, I will take at fair values. Here they are not mentioning the fair values separately. So if they are mentioned the fair values separately, I will take those fair values. Are they mentioned any fair values? Yes. Here they mention the fair value of net assets of AX Limited and BX Limited. So PPE inventory of BX Limited taken from here. Take these values, not these values. So PPE and inventory. PPE for inventory 1000 and 2900. PPE and inventory, 1 minute. For the PPE and inventory, I will take the figures from 1000 and 2900. For the balance sheet, we will take 1 minute. Will take 9,500 and 1,300 of AX Limited, because AX Limited is the acquiree, right? So acquiree assets and liabilities should be recorded at fair values. So 9,500 and inventory 1,300. So remaining all figures has been taken from the balance sheet itself. So apart from that, goodwill is very important. So goodwill is taken from this journal entry. So after that, taking the figures from the balance sheet, just observe this journal entry, and please ensure that each and every aspect has to be recorded in your books. These net assets has been recorded by looking at the balance sheet, but there might be a forgetting tendency of recording goodwill 900. So equity share capital and securities premium will come in the liability side. So equity share capital 7,500. 5,500 issued recently, and other equity 2,700 for BX Limited and 5,500 securities premium balance. Liabilities just taken from the balance sheet. So that's all. Then this is the case for the reverse acquisition. Then come to common control, because assuming that both entities are under common control. In this case, I need to use the pooling of interest method. So I will solve it. So ABX Limited is there, and AX Limited and BX Limited is also there. I need to find out the PC and net assets plus other equity. Why? Because in common control method, everything has been taken over by ABX Limited. So assets, liabilities and other equity at carrying values. So by common control method, by using pooling of interest method, AX Limited record assets, liabilities and other equity of acquirees in its acquirer CFS books. So and one more thing is PC paid through requisite number of shares. This is the information given in the question. ABX Limited issued requisite number of shares to discharge the claims of the equity shareholders of transfer companies. This point is useful for common control. Then calculation of purchase consideration. So they are saying that requisite number of shares, right? So I am finding out what is the requisite number of shares. Asset taken over. So all the carrying values taken from the balance sheet minus liabilities taken over, taken all the carrying values. So what is the net assets taken over? 9050 and 9700 minus other equity. We should minus the other equity as well. So then we will get the figures of 6000 and 7000. So what is the total purchase consideration? 6000 plus 7000 is the purchase consideration. This has to be paid for them because we are getting 1350 assets. From the assets I need to deduct liabilities and other equity. So I am getting the net assets of, I am getting the value of the assets of 6000 and 7000. So total I am getting 13,000. So I should pay 13,000 rupees for the both AX Limited and BX Limited. But which proportion? The proportion is in net assets taken over ratio, not this ratio. For the AX Limited 6000, for the BX Limited not 7000. This is not the case. This 13,000 has to be paid in the proportion of net assets taken over. So 9,500 plus 9,700, 18,750. So 13,000 into 9050 divided by 18,750. 9050 for AX Limited. So 6275 and he will use 9,700 of net assets taken over. So 6725 for the BX Limited. So please observe the 6275 here and it is 6725. Please write, please don't write the, I think we will get the same amount, don't write 6275 here. So there is some difference. So is given intentionally to make us tempted to write the both the values same. Then come to balance sheet. We got the purchase consideration right and we know the net assets plus other equity also. What is the net assets plus other equity? This is the net assets plus other equity 6000 and 7000 and we got the PC also. Then we can go for the balance sheet. The balance sheet simply we will record, we will add up the both the assets and liabilities of both the assets and liabilities from the balance sheet here also. But only one thing we cannot add is equity share capital only. For the equity share capital, I found out the PC, right? Because in common control transaction, PC has to be issued through the issue of shares. And PC has to be calculated by using the fair value of the shares. Okay, in acquisition method, I am using the fair value of the share, not the face value of the share. What is the face value here? So 10 rupees. So how many shares I have issued? So 13,000. So PC is the 13,000. We can directly mention the amount as 13,000. So total 28,250. This is the example for common control transactions. Next, illustration 3 from Super 50 deals with the concept of demerger. So Maxi Mini Limited has two divisions, Maxi and Mini. The draft information of assets and liabilities as at 31st October 2002 as was under PPE cost 600 and 300, depreciation, it is an accumulated depreciation, so 500 and 100, written on value 100 and 200. Current assets 400, 300. Current liabilities 100 for the both the divisions. There will be no loan funds in case of Maxi division. Only loan funds are there for Mini division That too, how much? 100. So the rupees are in crores. This is not 100 rupees, these are 100 crores. Then come to equity portion. Equity capital 50. There will not be separate equity capital for each division. So equity share capital and other equity might be on the name of the company. So 50 and 650. So this is the company. There are two divisions and we need to do further, we need further information to evaluate the nature of the problem. It is decided to form a new company, Mini Limited, to take over the assets and liabilities of Mini division. So what they are going to do? They are forming a new company, Mini Limited, to take over the assets and liabilities of Mini division. Accordingly, Mini Limited was incorporated to take over at balance sheet figures. So the assets and liabilities of that division. So they are taking only at balance sheet figures because it is common control transaction only. So it is indirectly giving hint. Then Mini Limited is allowed 5 crore equity shares of 10 each in the company to the members of Maxi Mini Limited. So they are mentioning to the members of Maxi Mini Limited. It means the PC consideration received by the company is not going to be recorded in equity books. Why? Because the PC is not received by the company. The PC is received by members of the Maxi Mini Limited. Then, in full settlement of the consideration, the members of Maxi Mini Limited are therefore to become members of Mini Limited as well without having to make any further further investment. The members of Maxi Mini Limited become the members of Mini Limited. So before also the control is with the members of the Maxi Mini Limited and Mini Limited is also controlled by the same members. So there is no change in the control. So the same members is controlled both the companies. So it is common control transaction. So you are required to pass journal entries in relation to the above in the books of Maxi Mini Limited and Mini Limited. Also show the balance sheets of two companies as on the morning of 1st November 2002 showing the corresponding previous year's figures. Then one more thing they are asking. The directors of two companies ask you to find out the net asset value of equity shares pre and post demerger. Comment on the impact of demerger on the shareholders' wealth. Demerged company, Mini division of Maxi Mini Limited, because it is demerging. It is coming out of the organization. So Mini division is transferring to the Mini Limited. The resulting company is Mini Limited. So they are asking journal entries in both the books. So first we will pass the journal entries in Maxi Mini Limited. Maxi Mini Limited, I need to take over all the assets and liabilities of Mini division. For this, I need to transfer all the assets and liabilities to realization account. So current liabilities 100, loan funds 100 and provision for depreciation 100. So PPE 300, current assets 300. So assets are transferred to credit balance because the assets are debit. So to transfer to realization, I need to give credit. For the liabilities, I need to make debit for taking out of our balance sheet. And the balancing figure is loss on reconstruction or loss on realization. Here we are doing reconstruction, right? So we are using the word reconstruction. Loss on reconstruction, balancing figure is 300. Then journal entries in the books of Mini Limited. The same amounts has to be recorded in the books of Mini Limited as well. But for the assets, we need to use the debit entry. For the liabilities, they need to give credit entry. So PPE 200, current assets 300. 200, 300. Here while we are passing the journal entry, we are providing for the gross amount. PPE we are deducting it as a gross amount and I separately mentioned provision for depreciation 100. Instead of that, here they are mentioning PPE 200, 300 minus 100. Current assets 300. So current assets 300. Remaining current liabilities, secured loan funds 100, 100. Current liabilities, secured loan funds 100 and 100. Then we will get two more entries, equity share capital and capital reserve. In the journal of Mini Limited, I will use the word equity share capital and capital reserve. Why? Because they are issuing equity shares for taking over the assets and liabilities of Mini division. So they are issuing 5 crore equity shares of 10 each to the members of the Maxi Mini Limited. So they are issuing to the members of Maxi Mini Limited, right? So that's why this PC entry is not recorded in the books of Maxi Mini Limited. Just I derecognizing the all the assets and liabilities. That's all. The balance sheet of Maxi and Mini Limited. After reconstruction, before reconstruction. Before reconstruction, taken directly from the question itself. Taken directly from the question itself. After reconstruction, just deduct these amounts from the total value. That's enough. PPE 200 because PPE 300 before 100 rupees pertains to mini division. So 200. Sorry, they're asking the balance sheet of Mini Limited. So 200, other current assets 300, equity share capital 50, and capital reserve mean other equity 250 rupees. Then come to liabilities. Borrowings 100 and current liabilities is 100, 500 rupees. Then come to the balance sheet. Balance sheet of Maxi Mini Limited. After reconstruction, before reconstruction. Before reconstruction taken from the balance sheet. After reconstruction, just deduct the assets and liabilities of Mini division. So 300 minus 200, 100. 700 minus 300, 400. So this will not be changed. 50 plus 350. It might change because there is loss on reconstruction, right? So loss on reconstruction is 300. So this is important here. Loss on reconstruction. Then come to fourth one. Illustration 4. Before solving the illustration 4, let's see some theory part. For understanding the difference between acquisition method and pooling of interest method. In acquisition method, I am using PC, but I am taking the 80% as an example. So depends on the question. Please change this percentage amount. PC 80%. What is the NCA balance then? 100 minus 80, 20. Then INA, identified net assets. What is identified net assets? Fair value of taken over assets minus fair value of taken over liabilities. So then I will get the amount. The resulting amount is a positive figure, then it is called goodwill. The resulting figure is a negative, it is called gain on bargain purchase or capital reserve. Depends on the situation. If we know the clear reason for this, then we need to use the word gain on bargain purchase. If we don't know the reason, then they are using capital reserve. In some questions they are referring as a capital reserve. In some questions they are mentioning as a gain on bargain purchase. You can write either of this, depends on the assumption. So most of the times write down the gain on bargain purchase. So then come to goodwill. There are two types of goodwills. Before understanding this, I need to understand the first of NCA. So for the NCA calculation, what is non-controlling interest? There are two methods, fair value method and proportionate net assets method. So full good value method, this is called partial goodwill method. In full goodwill method, the first formula is NCA shares. For example, I bought 80 shares. So remaining 20 shares, I haven't bought it from right. So NCA shares 20 into fair value of acquiry share. So acquiry company fair value might be there, right? So fair value of that share into NCA share. Then we will get the NCA value by using fair value method. If the fair value of acquiry share information is not given in the question, then use this PC divided by 80 into 100. So then this is the second method, second type in fair value method. We come to proportionate net assets method. This is called partial goodwill method. INA divided by 100 into 20. INA divided by 100 into 20. Then we will get the partial goodwill. So this partial goodwill is entirely related to the parent company only. So this is called full goodwill. This full goodwill is allocated to the parent and NCI. I will tell you in which proportion before that. If it is partial goodwill, it is allocated to the parent itself. So there is no question of allocation. Partial goodwill means the entire goodwill is related to the parent. Then come to illustration 4. ABC Limited acquires XYZ Limited in a business combinations on 15th January. Sorry, 1 minute. First we will discuss another sum, then we will come back to this one. Because just now we learned about the concept of partial and full goodwill, right? So regarding with this one, past paper question is there. I will explain you first that. Okay, this is the one. On 1st April 2022, H Limited acquired 75% of S Limited in cash at a premium of 500 lakh over the market price per share of 26 each, that is at a fair value of 20,000 lakhs. So this is the information given. What happened on 1/4/2022? H Limited acquired S Limited 75% shares at a premium of 500 lakhs. They are paying 500 lakhs premium over the market price per share of 26 each. So total 1000 lakh shares. Out of this I am acquiring 75%. That means I am acquiring 750 shares. What is the market price per share? 26 rupees. So 750 lakhs into 26, 19,500 lakhs. But I am paying extra 500 lakhs over the market price. What is the market price? 19,500 lakhs. 19,500 plus 500. I am total paying 20,000 lakhs. So that is the information given in the question at a fair value of 20,000. This 20,000 is arriving by this calculation. It has been given in the question for your understanding purpose. I just mentioned it because standardly we are following this calculation method. So that's why I am explaining. Then come to next information. On that date, S Limited had an issued and subscribed capital of 1000 lakh shares of 10 each, fully paid, and the balance 10,000 lakhs in its retained earnings, other equity. So what happened on that date? S Limited had an issued and subscribed capital. What is the amount? 1000 lakh shares and 10,000 lakhs in retained earnings, other equity. So equity share capital 10,000 lakhs, retained earnings 10,000 lakhs, total 20,000 lakhs will be there. Generally for the calculation of, first let's see for the information. The aggregate identifiable net assets of S Limited as on 1/4/2022 included an item of PPE whose fair value was lower than the book value by 1200 lakh. So they're giving the information of one PPE is there. It has been included in the identified net assets. Then that PPE fair value is lower than the book value by 1200 lakhs. Next, for other items, book value and fair value are the same. For the remaining all assets, book value equal to fair value. Then determine the, NCI was valued at fair value calculated at the market price per share. So NCI method is fair value method. And fair value method, first type or second type? First type, because they are giving the market price per share of acquirees 26 rupees each. And determine the NCI and goodwill on the date of acquisition. If the goodwill is impaired by 1540 lakhs on 31st/3/2023, how will the impairment loss shared by H Limited and NCA? Here I need to find out the NCA first. Is he mentioned anything regarding the method? Yes, that you need to use the fair value method. In fair value method, I explained there are two types. One is NCA shares into fair value of the share of acquiry. So what is the fair value or market price per share of acquiry? 26. So S Limited fair value per share is 26 rupees. So this information is given. So I am using the type 1 of fair value method. How many shares? So for 75%, 750 lakhs. For 25% is, so 25% is 250 lakh shares. So 250 lakh NCA shares into market price per share 26 rupees. So NCA is 6,500 lakhs. Then come to identify net assets. Is not giving the information directly regarding the calculation of identified net assets, but they are giving hints. To understand that, first, net assets equal to equity share capital plus other equity. So this formula is correct if preference shareholders and preference shareholders related aspects are not there in the balance sheet. Okay, then in that case net assets equal to equity share capital and other equity. If the preference share capital is there, this formula is wrong. I assume that there is no preference share capital in the sum. So net assets equal to, so equity share capital plus other equity in that case. They're mentioning, they're not giving the information directly about net assets. They're giving the information about the equity share capital and other equity. What is the equity share capital? 10,000 lakhs. What is the other equity? 10,000 lakhs. So I got the 20,000 lakhs. But here I need the fair value of net assets, not the carrying value of the net assets. They're saying that book value and fair value are the same, but except one item. What was that? PPE. So the PPE fair value is lower than 1200 lakhs. So what is my book value of total net assets? Carrying value of total net assets? 20,000 lakhs. So equity share capital plus other equity, 10,000 plus 10,000, 20,000 is the carrying value of the net assets. From this I need to deduct 1200 lakhs to get the fair value of the net assets. So 18,800 lakhs is the fair value of the net assets. So this amount has been taken from here. They mentioned that 1200 for arriving the fair value of PPE, I need to deduct 1200 lakhs from the book value. So that's why I have deducted 1200. Then I got the fair value of identified net assets 18,800 lakhs. So I got PC, I got NCA and I got INA. Then I can find out the goodwill. Here NCA method is I am using fair value. For the NCA calculation I am using fair value method. So the resultant goodwill is full goodwill. Full goodwill means the goodwill is related to parent company as well as NCA portion will be there. And one more information given on 31st/3 impairment loss is there. 1540 is the impairment loss. Then how to divide this impairment loss between the both parent company and as well as NCA, because the resultant goodwill is related to both. So the loss is also related to both the parent and NCA. Impairment loss 1540 goodwill. I need to deduct the value of the goodwill. So goodwill deducted. So 1540 deducted in the proportion of which proportion I need to do it. First, find out the proportionate goodwill, means partial goodwill, by using proportionate net assets method. Partial goodwill, how I need to find out?
If I want
Next illustration 3 from Super 50 deals with the concept of demerger.
NCA.
So Maxi
By
Mini
using
Limited has two divisions, Maxi and Mini.
net assets
The
method.
draft information of assets and liabilities as at 31st October 2002
So what is
as
the
was
net assets?
under
So NCA
PPE
equal
cost
to
600 and 300
18,800
depreciation is
divided
an
by
accumulated depreciation.
100%.
So 500
into
and 100
25%.
written on value 100
The NCA
and
by
200.
using net assets method is
Current assets 400 300
divided by
current
100
liabilities
into
100 for the
25.
both the company.
So
both the
4700
divisions.
is the NCA.
There will be no loan
So,
funds in case of
20,000
Maxi
is
division.
PC,
Only loan funds are there
4,700
for
is
mini division.
NCA,
That too.
and INA is 18,000.
How much?
800.
I'm just
So the
calculating
rupees
the
are in
goodwill
crores.
by using this is not 100 rupees
by
these are
using the
100 crores.
NCA
By up to equity portion.
sorry NC
Equity capital 50. There will not be separate equity capital for each division. So equity share capital and other equity might be on the name of the company. So 50 and 650. So this is the company. There are two divisions, and we need to do further. We need further information to evaluate the nature of the problem. It is decided to form a new company, Mini Limited, to take over the assets and liabilities of Mini division. So what they are going to do? They are forming a new company, Mini Limited, to take over the assets and liabilities of Mini division. Accordingly, Mini Limited was incorporated to take over at balance sheet figures. So the assets and liabilities of that division. So they are taking only at balance sheet figures because it is common control transaction only. So it is indirectly giving hint. Then Mini Limited is allowed 5 crore equity shares of 10 each in the company to the members of Maxi Mini Limited. So they are mentioning to the members of Maxi Mini Limited. It means the PC consideration received by the company is not going to be recorded in equity books. Why? Because the PC is not received by the company. The PC is received by members of the Maxi Mini Limited. Then, in full settlement of the consideration, the members of Maxi Mini Limited are therefore to become members of Mini Limited as well without having to make any further investment. The members of Maxi Mini Limited become the members of Mini Limited. So before also the control is with the members of the Maxi Mini Limited, and Mini Limited is also controlled by the same members. So there is no change in the control. So the same members is controlled the both the companies. So it is common control transaction. So you are required to pass journal entries in relation to the above in the books of Maxi Mini Limited and Mini Limited. Also show the balance sheets of two companies as on the morning of 1st November 2002, showing the corresponding previous year's figures. Then one more thing they are asking. The directors of two companies ask you to find out the net asset value of equity shares pre and post demerger. Comment on the impact of demerger on the shareholders' wealth. Demerged company, Mini division of Maxi Mini Limited, because it is demerging. It is coming out of the organization. So Mini division is transferring to the Mini Limited. The resulting company is Mini Limited. So they are asking journal entries in the both the books. So first we will pass the journal entries in Maxi Mini Limited. Maxi Mini Limited, I need to take over all the assets and liabilities of Mini division. For this, I need to transfer all the assets and liabilities to realization account. So current liabilities 100, loan funds 100, and provision for depreciation 100. So PPE 300, current assets 300. So assets are transferred to credit balance because the assets are debit. So to transfer to realization, I need to give credit. For the liabilities, I need to make debit for taking out of our balance sheet. And the balancing figure is loss on reconstruction or loss on realization. Here we are doing reconstruction, right? So we are using the word reconstruction. Loss on reconstruction, balancing figure is 300. Then journal entries in the books of Mini Limited. The same amounts
has to be recorded in the books of mini limited as well. But for the assets, we need to use the debit entry. For the liabilities, they need to give credit entry. So PPE 200, current assets 300. 200, 300. Here while we are passing the journal entry, we are providing for the gross amount. PPE we are deducting it as a gross amount, and I separately mentioned provision for depreciation 100. Instead of that, here they are mentioning PPE 200, 300 minus 100. Current assets 300. So current assets 300. Remaining current liabilities, secured loan funds 100, 100. Current liabilities, secured loan funds 100 and 100. Then we will get two more entries: equity share capital and capital reserve. In the journal of mini limited, I will use the word equity share capital and capital reserve. Why? Because they are issuing equity shares for taking over the assets and liabilities of mini division. So they are issuing 5 crore equity shares of 10 each to the members of the Maxi Mini Limited. So they are issuing to the members of Maxi Mini Limited, right? So that's why this PC entry is not recorded in the books of Maxi Mini Limited. Just I derecognizing all the assets and liabilities. That's all. The balance sheet of Maxi and Mini Limited. After reconstruction, before reconstruction. Before reconstruction, taken directly from the question itself. Taken directly from the question itself. After reconstruction, just deduct these amounts from the total value. That's enough. PPE 200, because PPE 300 before, 100 rupees pertains to mini division. So 200, sorry, they are asking the balance sheet of mini limited. So 200, other current assets 300, equity share capital 50, and capital reserve mean other equity 250 rupees. Then come to liabilities. Borrowings 100 and current liabilities is 100, 500 rupees. Then come to the balance sheet. Balance sheet of Maxi Mini Limited. After reconstruction, before reconstruction. Before reconstruction taken from the balance sheet. After reconstruction, just deduct the assets and liabilities of mini division. So 300 minus 200, 100. 700 minus 300, 400. So this will not be changed. 50 plus 350. It might change because there is loss on reconstruction, right? So loss on reconstruction is 300. So this is important here. Loss on reconstruction. Then come to fourth one. Illustration 4. Before solving the illustration 4, let's see some theory part for understanding the difference between acquisition method and pooling of interest method. In acquisition method, I am using PC, but I am taking the 80% as an example. So depends on the question. Please change this percentage amount. PC 80%. What is the NCA balance then? 100 minus 80, 20. Then INA, identified net assets. What is identified net assets? Fair value of taken over assets minus fair value of taken over liabilities. So then I will get the amount. The resulting amount is a positive figure, then it is called goodwill. The resulting figure is a negative, it is called gain on bargain purchase or capital reserve. Depends on the situation. If we know the clear reason for this, then we need to use the word gain on bargain purchase. If we don't know the reason, then they are using capital reserve. In some question they are referring as a capital reserve. In some question they are mentioning as a gain on bargain purchase. You can write either of this, depends on the assumption. So most of the times write down the gain on bargain purchase. So then come to goodwill. there are two types of goodwills. Before understanding this, I need to understand the first of NCA. So for the NCA calculation, what is non-controlling interest? There are two methods, fair value method and proportionate net assets method. So full good value method, this is called partial goodwill method. In full goodwill method, the first formula is NCA shares. For example, I bought 80 shares. So remaining 20 shares, I haven't bought it from right. So NCA shares 20 into fair value of acquiry share. So acquiry company fair value might be there, right? So fair value of that share into NCA share, then we will get the NCA value by using fair value method. If the fair value of acquiry share information is not given in the question, then use this PC divided by 80 into 100. So then this is the second method, second type in fair value method. We come to proportionate net assets method. This is called partial goodwill method. INA divided by 100 into 20. INA divided by 100 into 20. Then we will get the partial goodwill. So this partial goodwill is entirely related to the parent company only. So this is called full goodwill. This full goodwill is allocated to the parent and NCI. I will tell you in which proportion before that. If it is partial goodwill, it is allocated to the parent itself. So there is no question of allocation. Partial goodwill means the entire goodwill is related to the parent. Then come to illustration 4. ABC Limited acquires XYZ Limited in a business combinations on 15th January. Sorry, 1 minute. First we will discuss another sum, then we will come back to this one. Because just now we learned about the concept of partial and full goodwill, right? So regarding with this one past paper question is there. I will explain you first that. Okay, this is the one. On 1st April 2022, H Limited acquired 75% of S Limited in cash at a premium of 500 lakh over the market price per share of 26 each, that is at a fair value of 20,000 lakhs. So this is the information given. What happened on 1/4/2022? H Limited acquired S Limited 75% shares at a premium of 500 lakhs. They are paying 500 lakhs premium over the market price per share of 26 each. So total 1000 lakh shares. Out of this I am acquiring 75%. That means I am acquiring 750 shares. What is the market price per share? 26 rupees. So 750 lakhs into 26, 19,500 lakhs. But I am paying extra 500 lakhs over the market price. What is the market price? 19,500 lakhs. 19,500 plus 500. I am total paying 20,000 lakhs. So that is the information given in the question at a fair value of 20,000. This 20,000 is arriving by this calculation. It has been given in the question for your understanding purpose. I just mentioned it because standardly we are following this calculation method. So that's why I am explaining. Then come to next information. On that date, S Limited had an issued and subscribed capital of 1000 lakh shares of 10 each, fully paid, and the balance 10,000 lakhs in its retained earnings, other equity. So what happened on that date? S Limited had an issued and subscribed capital. What is the amount? 1000 lakh shares and 10,000 lakhs in retained earnings, other equity. So equity share capital 10,000 lakhs, retained earnings 10,000 lakhs, total 20,000 lakhs will be there. Generally for the calculation of, first let's see for the information. The aggregate identifiable net assets of S Limited as on 1/4/2022 included an item of PPE whose fair value was lower than the book value by 1200 lakh. So they're giving the information of one PPE is there. It has been included in the identified net assets, then that PPE fair value is lower than the book value by 1200 lakhs. Next, for other items, book value and fair value are the same. For the remaining all assets, book value equal to fair value. Then determine the, NCA was valued at fair value calculated at the market price per share. So NCA method is fair value method. And fair value method, first type or second type? First type, because they are giving the market price per share of acquiry is 26 rupees each. And determine the NCI and goodwill on the date of acquisition. If the goodwill is impaired by 1540 lakhs on 31st/3/2023, how will the impairment loss shared by H Limited and NCI? Here I need to find out the NCI first. Is he mentioned anything regarding the method? Yes, that you need to use the fair value method. In fair value method, I explained there are two types. One is NCI shares into fair value of the share of acquiry. So what is the fair value or market price per share of acquiry? 26. So S Limited fair value per share is 26 rupees. So this information is given. So I am using the type 1 of fair value method. How many shares? So for 75%, 750 lakhs. For 25% is, so 25% is 250 lakh shares. So 250 lakh NCA shares into market price per share 26 rupees. So NCA is 6,500 lakhs. Then come to identified net assets. Is not giving the information directly regarding the calculation of identified net assets, but they are giving hints. To understand that, first, net assets equal to equity share capital plus other equity. So this formula is correct if preference shareholders and preference shareholders related aspects are not there in the balance sheet. Okay, then in that case, net assets equal to equity share capital and other equity. If the preference share capital is there, this formula is wrong. I assume that there is no preference share capital in the sum. So net assets equal to, so equity share capital plus other equity in that case. They are mentioning, they are not giving the information directly about net assets. They are giving the information about the equity share capital and other equity. What is the equity share capital? 10,000 lakhs. What is the other equity? 10,000 lakhs. So I got the 20,000 lakhs. But here I need the fair value of net assets, not the carrying value of the net assets. They are saying that book value and fair value are the same, but except one item. What was that? PPE. So the PPE fair value is lower than 1200 lakhs. So what is my book value of total net assets? Carrying value of total net assets? 20,000 lakhs. So equity share capital plus other equity, 10,000 plus 10,000, 20,000 is the carrying value of the net assets. From this I need to deduct 1200 lakhs to get the fair value of the net assets. So 18,800 lakhs is the fair value of the net assets. So this amount has been taken from here. They mentioned that 1200 for arriving the fair value of PPE, I need to deduct 1200 lakhs from the book value. So that's why I have deducted 1200. Then I get the fair value of identified net assets 18,800 lakhs. So I got PC, I got NCA and I got INA. Then I can find out the goodwill. Here NCA method is I am using fair value. For the NCA calculation I am using fair value method. So the resultant goodwill is full goodwill. Full goodwill means the goodwill is related to parent company as well as NCA portion will be there. And one more information given on 31st/3 impairment loss is there. 1540 is the impairment loss. Then how to divide this impairment loss between the both parent company and as well as NCA, because the resultant goodwill is related to both. So the loss is also related to both the parent and NCA. Impairment loss 1540. Goodwill. I need to deduct the value of the goodwill. So goodwill deducted. So 1540 deducted in the proportion of which proportion I need to do it. First, find out the proportionate goodwill, means partial goodwill, by using proportionate net assets method. Partial goodwill, how I need to find out? If I want partial goodwill, I need to find out the NCA by using net assets method. So what is the net assets? So NCA equal to 18,800 divided by 100% into 25%. The NCA by using net assets method is 18,800 divided by 100 into 25. 4,700 is the NCA. So 20,000 is PC, 4,700 is NCA, and INA is 18,800. I am just calculating the goodwill by using the NCA by obtaining NC. Next, illustration 3 from Super 50 deals with the concept of demerger. So Maxi Mini Limited has two divisions, Maxi and Mini. The draft information of assets and liabilities as at 31st October 2002 as was under: PPE cost 600 and 300, depreciation, it is an accumulated depreciation, so 500 and 100, written on value 100 and 200. Current assets 400, 300. Current liabilities 100 for the both the divisions. There will be no loan funds in case of Maxi division. Only loan funds are there for Mini division. That too, how much? 100. So the rupees are in crores. This is not 100 rupees. These are 100 crores. Then come to equity portion. Equity capital 50. There will not be separate equity capital for each division. So equity share capital and other equity might be on the name of the company. So 50 and 650. So this is the company. There are two divisions, and we need to do further. We need further information to evaluate the nature of the problem. It is decided to form a new company, Mini Limited, to take over the assets and liabilities of Mini division. So what they are going to do? They are forming a new company, Mini Limited, to take over the assets and liabilities of Mini division. Accordingly, Mini Limited was incorporated to take over at balance sheet figures. So the assets and liabilities of that division. So they are taking only at balance sheet figures because it is common control transaction only. So it is indirectly giving hint. Then Mini Limited is allowed 5 crore equity shares of 10 each in the company to the members of Maxi Mini Limited. So they are mentioning to the members of Maxi Mini Limited. It means the PC consideration received by the company is not going to be recorded in equity books. Why? Because the PC is not received by the company. The PC is received by members of the Maxi Mini Limited. Then, in full settlement of the consideration, the members of Maxi Mini Limited are therefore to become members of Mini Limited as well without having to make any further investment. The members of Maxi Mini Limited become the members of Mini Limited. So before also the control is with the members of the Maxi Mini Limited, and Mini Limited is also controlled by the same members. So there is no change in the control. So the same members is controlled both the companies. So it is common control transaction. So you are required to pass journal entries in relation to the above in the books of Maxi Mini Limited and Mini Limited. Also show the balance sheets of two companies as on the morning of 1st November 2002, showing the corresponding previous year's figures. Then one more thing they are asking, the directors of two companies ask you to find out the net asset value of equity shares pre and post demerger. Comment on the impact of demerger on the shareholders' wealth. Demerged company, mini division of Maxi Mini Limited, because it is demerging, it is coming out of the organization. So mini division is transferring to the Mini Limited. The resulting company is Mini Limited. So they are asking journal entries in the both the books. So first we will pass the journal entries in Maxi Mini Limited. Maxi Mini Limited, I need to take over the all the assets and liabilities of Mini division. For this, I need to transfer all the assets and liabilities to realization account. So current liabilities 100, loan funds 100, and provision for depreciation 100. So PPE 300, current assets 300. So assets are transferred to credit balance because the assets are debit. So to transfer to realization, I need to give credit. For the liabilities, I need to make debit for taking out of our balance sheet. And the balancing figure is loss on reconstruction or loss on realization. Here we are doing reconstruction, right? So we are using the word reconstruction. Loss on reconstruction, balancing figure is 300. Then journal entries in the books of Mini Limited. The same amounts has to be recorded in the books of Mini Limited as well. But for the assets, we need to use the debit entry. For the liabilities, they need to give credit entry. So PPE 200, current assets 300. 200, 300. Here while we are passing the journal entry, we are providing for the gross amount. PPE we are deducting it as a gross amount, and I separately mentioned provision for depreciation 100. Instead of that, here they are mentioning PPE 200, 300 minus 100. Current assets 300. So current assets 300. Remaining current liabilities, secured loan funds 100, 100. Current liabilities, secured loan funds 100 and 100. Then we will get two more entries, equity share capital and capital reserve. In the journal of Mini Limited, I will use the word equity share capital and capital reserve. Why? Because they are issuing equity shares for taking over the assets and liabilities of Mini division. So they are issuing 5 crore equity shares of 10 each to the members of the Maxi Mini Limited. So they are issuing to the members of Maxi Mini Limited, right? So that's why this PC entry is not recorded in the books of Maxi Mini Limited. Just I derecognizing all the assets and liabilities. That's all. The balance sheet of Maxi and Mini Limited. After reconstruction, before reconstruction. Before reconstruction, taken directly from the question itself. Taken directly from the question itself. After reconstruction, just deduct these amounts from the total value. That's enough. PPE 200 because PPE 300 before 100 rupees pertains to Mini division. So 200. Sorry, they're asking the balance sheet of Mini Limited. So 200. Other current assets 300. Equity share capital 50. And capital reserve mean other equity 250 rupees. Then come to liabilities. Borrowings 100 and current liabilities is 100. 500 rupees. Then come to the balance sheet. Balance sheet of Maxi Mini Limited. After reconstruction, before reconstruction. Before reconstruction taken from the balance sheet. After reconstruction, just deduct the assets and liabilities of Mini division. So 300 minus 200, 100. 700 minus 300, 400. So this will not be changed. 50 plus 350. It might change because there is loss on reconstruction, right? So loss on reconstruction is 300. So this is important here. Loss on reconstruction. Then come to fourth one. Illustration 4. Before solving the illustration 4, let's see some theory part. For understanding the difference between acquisition method and pooling of interest method. In acquisition method, I am using PC, but I am taking the 80% as an example. So depends on the question. Please change this percentage amount. PC 80%. What is the NCA balance then? 100 minus 80, 20. Then INA, identified net assets. What is identified net assets? Fair value of taken over assets minus fair value of taken over liabilities. So then I will get the amount. The resulting amount is a positive figure, then it is called goodwill. The resulting figure is a negative, it is called gain on bargain purchase or capital reserve. Depends on the situation. If we know the clear reason for this, then we need to use the word gain on bargain purchase. If we don't know the reason, then they are using capital reserve. In some questions they are referring as a capital reserve. In some questions they are mentioning as a gain on bargain purchase. You can write either of this, depends on the assumption. So most of the times write down the gain on bargain purchase. So then come to goodwill. There are two types of goodwills. Before understanding this, I need to understand the first of NCA. So for the NCA calculation, what is non-controlling interest? There are two methods, fair value method and proportionate net assets method. So full good value method, this is called partial goodwill method. In full goodwill method, the first formula is NCA shares. For example, I bought 80 shares. So remaining 20 shares, I haven't bought it from right. So NCA shares 20. 20 into fair value of acquiry share. So acquiry company fair value might be there, right? So fair value of that share into NCA share. Then we will get the NCA value by using fair value method. If the fair value of acquiry share information is not given in the question, then use this PC divided by 80 into 100. So then this is the second method, second type in fair value method. We come to proportionate net assets method. This is called partial goodwill method. INA divided by 100 into 20. INA divided by 100 into 20. Then we will get the partial goodwill. So this partial goodwill is entirely related to the parent company only. So this is called full goodwill. This full goodwill is allocated to the parent and NCI. I will tell you in which proportion before that. If it is partial goodwill, it is allocated to the parent itself. So there is no question of allocation. Partial goodwill means the entire goodwill is related to the parent. Then come to illustration 4. ABC Limited acquires XYZ Limited in a business combinations on 15th January. Sorry, 1 minute. First we will discuss another sum, then we will come back to this one. Because just now we learned about the concept of partial and full goodwill, right? So regarding with this one, past paper question is there. I will explain you first that. Okay, this is the one. On 1st April 2022, H Limited acquired 75% of S Limited in cash at a premium of 500 lakh over the market price per share of 26 each, that is at a fair value of 20,000 lakhs. So this is the information given. What happened on 1/4/2022? H Limited acquired S Limited 75% shares at a premium of 500 lakhs. They are paying 500 lakhs premium over the market price per share of 26 each. So total 1000 lakh shares. Out of this I am acquiring 75%. That means I am acquiring 750 shares. What is the market price per share? 26 rupees. So 750 lakhs into 26, 19,500 lakhs. But I am paying extra 500 lakhs over the market price. What is the market price? 19,500 lakhs. 19,500 plus 500. I am total paying 20,000 lakhs. So that is the information given in the question at a fair value of 20,000. This 20,000 is arriving by this calculation. It has been given in the question for your understanding purpose. I just mentioned it because standardly we are following this calculation method. So that's why I am explaining. Then come to next information. On that date, S Limited had an issued and subscribed capital of 1000 lakh shares of 10 each, fully paid, and the balance 10,000 lakhs in its retained earnings, other equity. So what happened on that date? S Limited had an issued and subscribed capital. What is the amount? 1000 lakh shares and 10,000 lakhs in retained earnings, other equity. So equity share capital 10,000 lakhs, retained earnings 10,000 lakhs, total 20,000 lakhs will be there. Generally for the calculation of, first let's see for the information. The aggregate identifiable net assets of S Limited as on 1/4/2022 included an item of PPE whose fair value was lower than the book value by 1200 lakh. So they're giving the information of one PPE is there. It has been included in the identified net assets. Then that PPE fair value is lower than the book value by 1200 lakhs. Next, for other items, book value and fair value are the same. For the remaining all assets, book value equal to fair value. Then determine the, NCI was valued at fair value calculated at the market price per share. So NCI method is fair value method. And fair value method, first type or second type? First type, because they are giving the market price per share of acquiry is 26 rupees each. Then determine the NCI and goodwill on the date of acquisition. If the goodwill is impaired by 1540 lakhs on 31st/3/2023, how will the impairment loss shared by H Limited and NCI? Here I need to find out the NCI first. Is he mentioned anything regarding the method? Yes, that you need to use the fair value method. In fair value method, I explained there are two types. One is NCI shares into fair value of the share of acquiry. So what is the fair value or market price per share of acquiry? 26. So S Limited fair value per share is 26 rupees. So this information is given. So I am using the type 1 of fair value method. How many shares? So for 75%, 750 lakhs. For 25% is, so 25% is 250 lakh shares. So 250 lakh NCI shares into market price per share 26 rupees. So NCI is 6,500 lakhs. Then come to identified net assets. Is not giving the information directly regarding the calculation of identified net assets. Net assets equal to equity plus, equity share capital plus other equity. So this is the formula for net assets. Why I am using this formula? Because in question they are not mentioning about directly about the net assets. Because for calculation of goodwill I need the fair value of identified net assets. So net assets equal to equity share capital plus other equity. This formula is correct only by taking into the assumption of no preference share capital in the company. So I assumed here there is no preference share capital. So net assets equal to equity share capital plus other equity. Equity share capital 10,000 lakhs, other equity 10,000 lakhs. So total net assets is 20,000 lakhs. But this 20,000 lakhs is carrying value of net assets. So carrying value of net assets 20,000 lakhs, but I need the fair value of the net assets. In question they are mentioning book value and fair value are the same except for one. What was that? PPE. For the PPE, fair value is less than 1200 lakhs than the book value. What is the carrying value of the net assets? 20,000 lakhs. From this, if I deduct 1200 lakhs, then I will get the fair value of INA, identified net assets. So I can get the PC and NCA and INA. Then I got the goodwill. So what is the calculation method for the NCA? Fair value method. So the resultant goodwill is full goodwill. It means the goodwill is segregated to parent and NCA portion. So apart from this, they are mentioning impairment loss. The goodwill is related to both NCA and parent. Then impairment loss is also allocated to parent and NCA. In which proportion? For this, I need to find out the partial goodwill, because partial goodwill is entirely related to the parent company. So calculation of partial goodwill. What is the PC? PC amount is 20,000 lakhs plus what is the NCA portion? Here I need to use the method of identified net assets for the calculation of NCA. What is the INA? 18,800 divided by 100 into 25. So what is the amount? 18,800 divided by 100 into 25, 4,700 lakhs. So minus identified net assets equal to 18,800 lakhs. So what is the goodwill here? The goodwill amount is 20,000 plus 4,700 minus 18,800. So 5,900 lakhs is the partial goodwill. It means the entire goodwill is related to parent company only. What is the parent company here? H Limited. So parent company H Limited. So this is the partial goodwill. What is the total goodwill? Total goodwill equal to, so total goodwill is 7,700. Total goodwill 7,700 lakhs minus parent goodwill 5,900 lakhs. So the balance goodwill is related to NCA. What is the NCA portion? 7,700 minus 5,900 equal to 1,800 lakhs. So this goodwill is related to NCA portion. So now what is the impairment loss? The impairment loss equal to 1540. This 1540 impairment loss has to be allocated between H Limited and NCA in the proportion of their goodwills. Impairment loss 1540 divided by, what is the total goodwill? 7,700 lakhs. So this is H Limited and this is NCA. For the H Limited, what is the goodwill? The goodwill amount is 5,900 lakhs. For NCA also 1540 is the impairment loss. Total goodwill 7,700. What is the goodwill pertaining to NCA? 1,800 lakhs. So Then I will got the impairment loss amount for the H Limited. 1540 divided by 7700 into 5900 equal to 1180 lakhs. This is the impairment loss for H Limited. What is the impairment loss for NCI? 1540 divided by 7700 into 1800, so 360 lakhs. So the journal entry is total 1540 is the impairment loss. Out of this, what is the H Limited portion? 1180 lakhs. Then NCA portion is 360 lakhs. Okay, NCA portion is 360 lakhs. This is the way to allocate the impairment loss between the parent and NCI. Then let's go to illustration 4 from the Super 50. So this is the different concept. So what is the fair value for the contingent liability? For calculation of identified net asset, I need to consider the contingent liability also sometimes. For this contingent liability, what is the value? I need to take the fair value of the contingent liability. So this fair value is based on some information and some estimations. So what if this estimation has to be changed after the acquisition date? So this accounting treatment is explained with this illustration. ABC Limited acquires XYZ Limited in a business combination on 15th January 2001. What is the date of acquisition? 15th January. Few days before the date of acquisition, one of the XYZ Limited customers had claimed that certain amounts were due by XYZ Limited under penalty clauses for the completion delays included in the contract. So, one customer filed a complaint against XYZ Limited. This is acquiring company. So, there is a complaint against acquiring company. So, for this, they need to pay the penalty in the future. So we don't know. So ABC Limited evaluates the dispute based on the information available on the date of acquisition and concludes that XYZ Limited was responsible for at least some of the delays in completing the contract. Based on the evaluation, ABC Limited recognizes 1 crore towards this liability, which is its best estimate of fair value of the liability to the customer based on the information available at the date of acquisition. On the date of acquisition, what is the fair value of the liability? 1 crore rupees is the fair value liability, which has to be used in the calculation of INA. Then in October 2001, within the measurement period. What is the measurement period? Measurement period means within the 1 year from the date of acquisition. So what is the date of acquisition? 15th January 2001. So what is the measurement period? 15th January 2001 to 15th January 2002. So this new information is received within the measurement period. So what is the information is received on October 2001. So the customer presents the additional information as per which ABC Limited concludes the fair value of liability on the date of acquisition is 2 crores. So on October 2001, I am calculating the fair value of the liability on the date of acquisition is 2 crores. So I am revising my liability as 2 crores. Then come to further information. ABC Limited continues to receive and evaluate the information related to the claim after October 2001, and its evaluation does not change till February 2002. So that is after the measurement period. When it concludes that the fair value of the liability for the claim at the date of acquisition is 1.9 crores. So on February, so it is measuring they are measuring the fair value of the contingent liability is 1.9 crore. Then ABC Limited determines that the amount that would be recognized with respect to the claim under Ind AS 37 provisions, contingent liabilities and contingent assets as at February 2002 is 2.2 crores. So ABC Limited determines the amount, that is 2.2 crores. This amount has been determined on the balance sheet date. Okay, on balance sheet date they are measuring the fair value of the liabilities 2.2 crores. And come to the problem. So the date of acquisition is 15th January. So I need to record the contingent liability at fair value of 1 crore because that is the fair value on the date of acquisition. But after that, further information is received. So that information is received within 1 year from the date of acquisition. The accounting treatment is I need to adjust to the fair value of the liability and I need to change the goodwill accordingly. So if that information is received after 1 year from the date of acquisition, then such change, whether it is increase or decrease, that in the liability should be dealing as per Ind AS 37. What is the remeasurement period? Remeasurement period means within 1 year from the date of acquisition. Then come on October 2001, the fair value of the liability is 2 crores. So this info is received within 1 year, right? So on 31st 2002, so I can adjust this transaction according to the Ind AS 103. So adjust to the fair value of the liability and goodwill. Then, so in February we got the information regarding the fair value of the liabilities 1.9 crores. I simply ignore this info because it is received after remeasurement period. Then come to 31st 2002. On this date, the fair value of the liability becomes 2.2 crores. So it becomes 2.2 crores. So I cannot adjust the fair value of the liability and goodwill because I am standing on 31st 2002. On that date, the remeasurement period has been expired. So originally I recorded for 2 crores. Now it becomes 2.2 crores. So the remaining amount has to be recognized in P&L. Okay. Then come to step acquisition. Next concept is regarding with the step acquisition. Entity A acquired 35% of entity P on 1/4/2019 for 35,000. So 35,000 they bought it for 35%, they bought it for 35,000 rupees. On 31st 2020, the fair value, 1 minute, fair value of shares of entity B is 42,000. The 7,000 reported under OCI in 2019-20. On 1/7/20, entity A further acquired 40% stake in entity B. So consideration paid is 60,000 rupees. Entity A identifies the net assets of entity B at fair value of rupees 1,20,000 at the acquisition date. Value of 35% shares at 45,000. NCI is valued at proportionate net assets. Show the workings and journal entries. So here entity A acquired 35% on 1/4/19 for 35,000. So on 1/4/19, 35% shares we bought for 35,000 rupees. So this 35% share is less than 50%, but greater than or equal to 20%. Sir, why you are mentioning these percentage values? Because let's go back to acquisition by the shares concept. So this is acquisition by shares. In acquisition by shares, if we acquire the control of shares, if we acquire the control of the entity, we need to acquire at least 50% of the shares. Then only we can get the control. If you got the control, then only is accounting treatment as per Ind AS 103. but so the percentage of shareholding is greater than or equal to 50%. What if it is less than 50%? So if it is less than 50%, the accounting treatment as per Ind AS 28. Ind AS 28. So in this problem, the percentage is less than 50%. So Ind AS 28 will come into picture. Sir, what is the method in Ind AS 28? We will use equity method. What is equity method? Equity method means we can measure the investment at the rate of share in the net assets or equity of the acquiree. So generally in Ind AS 103, we will record all the assets and liabilities at fair values, or assets or liabilities and equity at carrying values, depends on the type of business transaction. But in this method, we can record only our share in the net assets. Not we cannot write the entire net assets in our books. We can write only to the extent of our percentage shareholding in the acquiree. So I bought it for 35,000. And it becomes the fair value of the shares of entity B is 42,000. So it becomes 42,000 on 31st/3/20. So how it becomes 42,000? OCA is there which have been earned in 1920, 7,000 OCA. OCA means assume that it's a kind of gain. It's a kind of unrealized gains. So OCA means other comprehensive income. So 1920 other comprehensive income 7,000. 7,000 is our share. So I bought it for 35,000. My share is 7,000. Then my investment becomes 42,000. So come to next info. On 1720, so entity acquired one more further percentage, 40%. The consideration paid is 60,000. So for 40%, they paid 60,000. Then on the acquisition date, the value of 35% shares at 45,000. So this 35,000 becomes 45,000. How it becomes 45,000? Maybe our profit might be earned during that period. So this is our share of profit, because it becomes from 42,000 to 45,000. So I assume that this 3,000 is the profit earned during that period. So here is the journal entries. On 1/4/2009, I bought 35% of at 35,000. So investment account debit to cash account. So this is 35,000, right? So I need to follow the equity method. So 31st/3/2020. Investment I need to revalue at 42,000. So I need to increase the investment by 7,000. Investment account debit to not P&L. Here OCA. I need to use the word OCA. Because of other comprehensive income, investment is increased by 7,000. So come to 1720. On 1720, this 35% becomes 45,000. So there is an increase in the value of 3,000. But here I use the word P&L account instead of OCA. Why? Because on 1/7/2020, investment should be derecognized from the books. So investment will not be there, will not continue in the books. So that's why I used P&L instead of OCA. Sir, why you need to derecognize it from the books? Because on 1/7/2020, purchase another 40%. If I purchased one more 40%, then total, what is the total share percentage? 75%. So it is greater than or equal to 50%. So I need to start the accounting process as per Ind AS 103, and I need to stop the accounting process as per Ind AS 128. What does it mean, stop accounting? It means I need to derecognize the investment. So here is the journal entry about purchase consideration. So I bought 40% by paying PC 60,000. So what is the previous PC? Previous purchase consideration is 35%. I need to revalue the PC. I need to revalue the previously held percentage at 45,000 because it becomes 45,000, right? By adding by adding 3,000, it becomes 45,000. So the fair value of the previously held investment is 45,000. Then comes to NCA, non-controlling interest. In question itself, they are mentioning NCA is valued at proportionate net assets. What is the net assets? So consider entity A identifies the net assets of entity B at a fair value of 1,20,000 on the acquisition date. So net assets is 1,20,000. So 1,20,000 divided by 100 into 25, NCA 30,000. So what is the journal entry for this? Net assets account debit to, so 1,20,000 and goodwill 15,000 to purchase consideration 60,000. For 40%, it is 60,000 only, right? Then come to investment. Because in our books, in our consolidated financial statement, I am showing the investment at 45,000. This 45,000 should be de-recognized from my books. So how should I de-recognize from my books? So investment is a debit balance. If I make it a credit entry to the extent of 45,000, it should be de-recognized from the books. So investment account to NCA 30,000. Then investment is de-recognized, right? Then what we should do? OCI relating to investment is transferred to P&L. What is the OCI balance pertaining to this investment account? 7,000. So on the de-recognition date, this OCI balance classified to P&L account. So that's why pass the journal entry OCI account debit to P&L account. On 1/7/20, the investment becomes 45,000, right? So remaining 33,000 transferred to P&L because on this date investment should be de-recognized from the books. That's why I used P&L instead of OCI. So here 3,000 is transferred to P&L and here 7,000 is transferred to P&L from OCI account 7,000. What is the total amount transferred to P&L on the acquisition date? 7,000 and 3,000. Total 10,000. So this is the journal entry, investment account, OCI account debit to P&L account 10,000. Here they pass the consolidated journal entry. And we have passed the journal entries separately. OCI account debit to P&L account and investment account debit to P&L account. Then come to next one. Illustration 7. On 1/4/2020, Gold Limited acquired 75% share of Coal Limited at 10,80,000 when the fair value of its net assets was 1 crore. 10 lakh. Net assets was 10 lakh. During 1/4/2020 to 31st/3/21, so during this 2021 period, Coal Limited made OCI 2 lakh rupees. So what is the OCI balance? 2 lakh rupees which it has earned during the period 2021. On 31st/3/21, Gold Limited sold or purchased 15% holding from the outsiders at 2,20,000 rupees. So there are two cases. The first case is I have sold 15% shareholding to the outsiders at 2,20,000. The second case is I have purchased 15% shareholding from the outsiders at 2,20,000 rupees. So pass the journal entries for the sale or purchase of partial holding retaining control. So we are selling some control. We are selling some percentage of shares without losing the control. Then NCA is valued at proportionate net assets value or fair value. So first case, sale of 15% of holding. Sale of 15% of holding. So I bought the 75% for 10,80,000. So what is the carrying amount of 15% out of this 75%? So my total amount is 10,80,000. So 10,80,000 into 15%. Then when I am selling this percentage holding on 31st 3/21, so 2021, so the profit is 2 lakh, right? So I had the share of profit, right? So 15% of OCI. So this is OCI. 15% of OCI. Total 1,92,000. So 10,80,000 into 15% and 2 lakh into 15%, then it becomes 1,92,000.
Sale price is 2,20,000 rupees. So the carrying amount of 15% is 1,92,000 and the sale price is 2,20,000. So what is the gain? The gain is 2,20,000 minus 1,92,000, 28,000. Next. What is the journal entry? Bank account debit to. So we will get 2,20,000 rupees. And our NCA has to be increased to the extent of 1,92,000. The carrying amount of 15% shareholding is 10,80,000 into 15%. And what is the OCI? 2 lakh. 2 lakh into 15%. Total 1,92,000. Then come to purchase of shares from outsiders. The first case is sale of holding. Second case is purchase of 15% holding for 2,20,000 rupees. So here NCI is recognized at proportionate net asset value and NCI is recognized at fair value. So they are giving two cases. So I am doing the first one. So 15% holding equal to 15% into 10 lakh plus 2 lakh is the OCI, right? So they are using net assets, proportionate net assets method. What is the net assets as on the date of acquisition? 10 lakhs. Net assets on date of acquisition 10 lakhs. During 2021 we earned 2 lakh rupees. So our net asset becomes 12 lakhs. So 12 lakh into 15%. What is the 15% holding carrying value? So 15% into 12 lakhs, 1,80,000. Then what is the purchase price? 2,20,000 rupees. So the value of 15% holding is 1,80,000, but I am paying 2,20,000. So I am paying extra 40,000, which is a loss. So bank account I paid 2,20,000. Out of this NCI is reduced. One liability is reducing by paying 2,20,000 rupees, but the liability is reducing to the extent of 1,80,000 only. So remaining 40,000 is loss. Loss need to be transferred to other equity. Then NCI is recognized at fair value. So what is the carrying amount of 15%? For 75%, 10,80,000. So 10,80,000 divided by 75% into 15%. This is the NCI as on the date of acquisition. But we are on the date of 31st 3/2022. So during 21-22 we made OCA of 15. So we made OCA of 2 lakh rupees. So 15% of 2 lakh plus NCI as on date of acquisition 2,46,000 rupees. Purchase price is 2,20,000. So here is the gain. Why? Because we are reducing the NCI, means liability, to the extent of 2,46,000 rupees just by paying 2,20,000 only. So remaining 26,000 is profit. So transfer to other equity. Then the business combination is over. Then come to internal reconstruction. So in the internal reconstruction there is one problem. If you solve this,
then it is enough. Then the second part of our chapter is internal reconstruction. So illustration 5 of Super 50. So Haldi Tulsi Limited provides you following information as at 31st March 2023. So equity share capital of 10 each, 500 lakhs, 6% cumulative preference shares of 10 each, 100. Profit and loss account debit balance is there. So highlight this one, 15 lakhs, 10% first debenture 60 and 10% second debenture 100 and debentures interest outstanding 16. So this is an important, and profit and loss account debit balance is also need to highlight it. Then come to trade creditors, 165 lakhs, plant and machinery 719.6. So dividend on preference shares are in arrears for 3 years. So dividend on preference shares are arrears for 3 years. So from 3 years dividend has not been paying for the preference shareholders. Then come to further information. These are the adjustments. All the equity shares to be converted into the same number of equity shares of 5 each, 2.50 paid up. So I need to pass the journal entry for this. Then the preference shares are converted from 6% to 15%, but revalued in a manner in which the total return on them remains unaffected. So the preference shares are transferred from 6% to 15%, but the total return should be remain the same. So that is the condition. 4 equity shares of 5 each, rupees 2.5 paid up to be issued for each 100 rupees of arrears of preference dividend. Then Mr. A holds 10% of first debentures for 40 lakhs and 10% of second debentures for 60 lakhs. He is also a creditor for 10 lakhs. So Mr. A is to cancel 60 lakhs of his total debt and to pay 10 lakhs to the company. He is paying to the company in the cash of 10 lakh rupees and to receive 12% debentures for the balance amount. Then Mr. B holds the remaining 10% first debentures and 10% second debentures and is also a creditor for 5 lakh rupees. Then Mr. B is to cancel the 30 lakhs of his total debt and to accept 12% debentures for the balance amount. Trade creditors other than A and B are given the option of either to accept equity shares of rupees 5, 2.5 paid up each for the amount due to them, or the second option is to accept 80% of the amount due in cash. 40% creditors accepted the equity shares and remaining 60% accepted cash in full settlement. Then any surplus after writing of the various losses be utilized in writing down the value of plant and machinery. So the surplus available after writing of the various losses, the remaining balance should be utilized for writing down the value of the plant and machinery. So prepare the reconstruction account. So the first one is one minute. Central reconstruction. They are saying all equity shares are converted into same number of equity shares of rupees 5, 2.50 paid up. How many number of equity shares are there? So there are 50 lakh equity shares. Into 10 rupees it becomes 500. So all the shares are converted into face value 5 rupees and paid up value 2.50. So equity share capital, I have cancelled the original equity share capital to the extent of 500 lakhs and I created new equity share capital 2.5 paid each. So 50 lakh into 2.5, 125. Remaining balance transferred to capital reduction account. Then come to preference shares are converted from 6% to 15% but revalued in a manner in which total return on them remains unaffected. So first I need to find out the total amount due to the preference shareholders. So return on 6% preference share capital of 100 lakhs. What is the preference share capital? 6% cumulative preference shares of 10 each is 100. So there is 100 lakhs. So 100 lakhs into what is the percentage? 6%. So the return is 6 lakhs. So the new share capital has been issued in a manner the return should not be changed. I assumed that return on the 15% preference share capital of, I don't know the amount, right? So I assumed it is X. So amount X into 15% should be equal to 6 lakhs because he is saying that the return is same. The return is same for the 6% and 15%. So I can take it as X into 15% is equal to 6 lakhs. Then I can find out the X, it is 40 lakhs. So I can get the 40 lakhs worth of 15% preference share capital in exchange of 6% preference share capital. So 40 lakhs then. Then one more info is there, right? So arrears of preference dividend is there for 3 years. So 100 lakhs into 6% is 6 lakhs is the preference dividend per year. So the arrears of dividend for 3 years. So 6 lakh into 3, 18 lakhs. Total 18 lakhs. So for every 100 rupees, they are paying 4 equity shares. They are saying that 4 equity shares, 2.5 paid up to be issued for each 100 rupees of arrears of preference dividend. If 100 rupees is arrears, I will pay 4 equity shares. Now the arrears of preference dividend is 18 lakhs. How much I need to pay? So 18 lakh divided by 100 into 4. I will issue 72,000 shares. 72,000 shares of 2.50 paid each. Total 6% preference share capital 100 lakhs. So I cancelled 6% preference share capital. They have issued 15% preference share capital for 40 lakhs worth of 40 lakhs. How I need to get the 40 lakhs here? So 15% share capital remaining transferred to capital reduction account 60 lakhs. Then arrears of preference dividend is not recorded in the balance sheet. Arrears of preference dividend is, it has been given as a note but it is not recorded in the balance sheet. So first I need to transfer to the capital reduction account. So capital reduction account debit to arrears of preference dividend. I need to pay arrears of preference dividend, right? For that I need to take it into my books by using capital reduction account. Capital reduction account to arrears of preference dividend 18 lakhs. Then arrears of preference dividend paid by issuing equity share capital. How many shares? 72,000 shares. The paid up is 2.50. So then I can get the 1.8 lakhs. Remaining I need to transfer to capital reduction account. So this is the detailed journal entry. So in our answer they are providing consolidated journal entry. Capital reduction account debit to equity share capital 1.8 lakh. So arrears of preference dividend, arrears of preference dividend. Capital reduction here it is 18 lakhs. Here credit 16.2. So in debit capital reduction 1.8 lakhs. In credit equity share capital 1.8 lakhs. This is the journal entry. Then go to third one. So Mr. A holds 10% debenture 60 lakhs and 10% second debenture 60 lakhs. here one more thing I need to remember. Debenture interest is also there. That is 16 lakhs. So what is the amount due to the Mr. A? First 10% first debentures 40 lakhs. Second debenture 60 lakhs. And outstanding debenture interest is there, right? So what is the outstanding debenture interest? Total 16. Debenture interest is 16 lakhs. So what is the due amount? 100 lakhs. 100 lakhs into 10 percentage. This is the outstanding debenture interest for A. And he is also creditor for 10 lakhs. And in return, he is paying 10 lakh rupees. So he is paying 10 lakh rupees to the company. So these are all the amounts which I need to due to the Mr. A. So total 130 lakhs. So how I am settling this 130 lakhs? Mr. A account debit to capital reduction account 60 lakhs to 12% debentures 70 lakhs. 12% debentures 70 lakhs. How I am getting this figure? So total amount due is 130 lakhs. So I am paying just 12% debentures of 70 lakhs only. Because Mr. A to cancel 60 lakhs. So Mr. A cancel 60 lakhs. So the balancing figure is 70 lakhs. The balancing amount is settled by issuing 12% debentures. What is the foregoing amount? 60 lakhs. Mr. A waive off his liability. Means it cancel his liability. Then come to Mr. B. Mr. B holds 10% first debentures and 10% second debentures. The remaining 10% is. So what is the total? The total 60 lakhs. Second debentures 100 lakhs. Out of the 60 and 100, 40 and 60 with respect to Mr. A. Balancing is related to Mr. B. What is the outstanding debentures? 20 plus 40, 60. So 60 into 10% is outstanding debenture interest is 6 lakhs. And come to creditor. Is a creditor for 5 lakh rupees to Mr. B. The total amount due is 71 lakhs. So what is the foregoing amount by Mr. B? Mr. B to cancel 30 lakhs. So 30 lakhs transferred to capital reduction account. The balance amount has been settled by issuing 12% debentures. Come to trade creditors. What is the total amount of trade creditors? 165. Out of this 165, 10 lakhs by the Mr. A and 5 lakhs by Mr. B. Remaining outside other than A and B, 150 lakhs is the trade creditors. These trade creditors 40% creditors accepted equity shares. So 150 lakhs into 40% is 24 lakhs, 60 lakhs. This 60 lakhs has to be settled by issuing equity share capital of paid up 2.5. So how many shares I need to issue? 24 lakhs into 2.5, equity share capital 60 lakhs. Then remaining 60% is accepted cash to the extent of 80%. So they cannot pay it fully. So they paid to the extent of 80% only. So 90 lakhs. 60% into 150 lakhs, 90 lakhs. I cannot pay entire 90 lakhs. So 90 lakhs into 80%, I will pay only 70 lakhs. 72 lakhs. Here the balancing figure 80 lakhs should be transferred to the capital reduction account. Any surplus after writing off the losses should be utilized for writing off of plant and machinery. So I created capital reduction account. So transfer the every amount over here. Equity share capital 375. So equity share capital 375 and 6% preference share capital 60 lakhs, and take the consolidated entry, don't do it for both the entries separately. So capital reduction account debit to equity share capital account. So in capital reduction account to equity share capital 1.8 lakhs. Then come to Mr. A. In Mr. A, what is the capital reduction? 60 lakhs. For Mr. B, what is the capital reduction? It is 30 lakhs. Then come to trade creditors. The trade creditors, what is the capital reduction? 18 lakhs. So trade creditors 18 lakhs, B foregoing 30 lakhs, Mr. E is losing 60 lakhs, preference share capital 60 lakhs. This is equity share capital. I need to check the P&L debit balance. What is the P&L debit balance? P&L debit balance is 15 lakhs. So P&L debit balance 15 lakhs. I need to reduce it from the capital reduction account. The remaining balance I need to use it for writing of plant and machinery. The balancing figure is 526.2. So that's it for the session. So we covered the business combinations and internal reconstruction. Business combinations, common control method, normal method. In normal method, normal acquisition, reverse acquisition. So for the normal acquisition method, what is the method? Acquisition method. So PC plus NCI minus INA, then we will get the goodwill or gain on bargain purchase. For common control method, what is the method name? The method name is pooling of interest method. In pooling of interest method, we can record assets, liabilities and other equity at carrying values. In acquisition method, we can record assets and liabilities at fair value. So this is the basic difference. The purchase consideration. In acquisition method, the purchase consideration is recorded at fair value. Most of the times fair value. Of course, there are some exceptions also. For the deferred consideration, I need to take the present value, not fair value. Then come to common control method. In common control method, the consideration is most of the times in the form of shares. So I need to take the face value of the shares or nominal value of the shares for the calculation of purchase consideration. Then one demerger, we have discussed the demerger problem also, and internal reconstruction problem, and step acquisition method, and goodwill impairment of goodwill. So all these types of sums we have discussed. Next chapter.
Welcome back. The today chapter is consolidated financial statements and separate financial statement, CFS and SFS. In example, Mehta Limited is there. If people wanted to invest in Mehta Limited, they need to observe the financial performance of the Mehta Limited. So how can they know the financial performance? By looking into the financial statements of the company. So as per the Companies Act, every company should prepare financial statements. These are called separate financial statements. Now, Mehta Limited is invested 20% shares in BCCA Limited. Now, people is showing interest to know the performance of not only Mehta Limited, they wanted to know the performance of BCCA Limited as well, because Mehta Limited has shares in BCCA Limited. If anyone wanted to invest in Mehta Limited, they are not only observing the performance of Mehta, but also they are observing the performance of BCCA Limited. So, to know the group performance, Companies Act insisted the companies to prepare the consolidated financial statements along with the separate financial statements. Now, one company has significant influence over another company, then it becomes associate company to the original company. So the accounting treatment is as per Ind AS 28. It has been learned in the business combinations chapter. Then come to next one. Here Mehta Limited has got control over BCCA Limited. Here how they got control? By invested 50% of the shares.
So it becomes subsidiary. So I need to, Mehta Limited as a parent should prepare the consolidated financial statements to depict its group performance. Now, on the date of acquisition, it should prepare consolidated financial statements as per Ind AS 103. It has been discussed in the last session. Now, on every reporting date, parent company shall prepare consolidated financial statements by using the accounting principles stated in the Ind AS 110. So the today chapter is mainly focused on the Ind AS 110. Then come to so in problems they are giving on every balance sheet date need to prepare consolidated financial statements as per Ind AS 110 of all its subsidiaries. How it became subsidiary? If you got control, then it becomes a subsidiary. How we are getting the control here? By acquiring greater than or equal to 50% shares. Now, in question, they will provide the separate financial statements of parent company and subsidiary company. And we need to prepare the consolidated financial statements as on the balance sheet date. This is the basic problems given in the exam. So for this, so generally for preparation of the consolidated financial statements, what are the inputs we should have? Purchase consideration mainly, and identified net assets, the fair value of identified net assets. Before going into this, I just want to remind some basic formulas. So I want fair value of net assets on the date of acquisition, right? But in problems, they are not giving information directly about the fair value of the net assets as like Ind AS 103. Now I need to find out the fair value of the net assets. So instead of information about net assets, they are giving information about the equity. Okay, so equity share capital plus other equity. So here net assets equal to equity share capital plus other equity. Remember this. So net assets equal to equity. I want net assets on the date of acquisition. If I find out the equity on the date of acquisition, then I can know the net assets on the date of acquisition, right? So how I am finding the equity on date of acquisition? Opening equity plus pre-acquisition profit. Then I got the equity on date of acquisition. How I am getting the profit here? So total profit equal to closing equity minus opening equity. Then I got the total profit. The total profit has to be segregated pre-acquisition profit and post-acquisition profit. If post-acquisition profit is added to the opening equity, then I can get the equity on the date of acquisition. Then so I got the equity on the date of acquisition, but I need the fair value of net assets, not the carrying value of net assets. So equity on the date of acquisition plus fair value adjustments equal to fair value of net assets. So here closing equity and opening equity will be given in the question. Okay, so by using these two factors, we can find out the fair value of the net assets on the date of acquisition. Sir, how about PC? So what is the purchase consideration and how can we know that? So come back once. If you bought any shares in any company, what is the journal entry? What is the journal entry in separate financial statements? Investment account debit to cash account. Here I bought less than 20%, so there is no need of consolidation. So only one set of books will be the investment account debit to cash. Here I'm purchasing greater than or equal to 20%. So in consolidated financial statements, I am using the Ind AS 28. Okay. Then separate financial statements, the entry is same. Investment account debit to cash account. So whatever the investments, whatever the purchase consideration we are paying for them, it is shown as a investment in separate financial statements. So by observing the separate financial statements, we can know the purchase consideration.
So in balance sheet, they will give the information regarding the investments. So let's go for Super 50 questions. So here Ram Limited acquired 60% ordinary shares of 100 each of Krishna Limited. So on 1st October 2001, on 31st March 2002, the summarized balance sheet of two companies were given below. What they are giving? They are giving the two separate financial statements of the companies, and they are asking us to prepare consolidated financial statements. For this, I need purchase consideration and fair value of identified net assets. So how can I know the purchase consideration? They will give the information regarding the investments. So this is separate financial statements, right? So the PC has to be recorded in the form of investments. So investments in Krishna Limited 8 lakh rupees. So this is my purchase consideration. Then go for fair value of net assets on the date of acquisition. I don't know, but by using closing equity and opening equity, I can find out the fair value of net assets on the date of acquisition. So I am searching for the closing equity. So the equity as on 31st March 2002. So this is my closing equity. So then I want to know the opening equity. So where is the opening equity? The retained earnings of Krishna Limited. The retained earnings of Krishna Limited showed a credit balance of 60,000 on 1st April 2001, out of which a dividend of 10% was paid on 1st November. So what is the retained earnings of the Krishna Limited? 60,000. So this is opening equity. They are not giving information regarding equity share capital and retained earnings, other reserves, but they are giving information regarding the opening of retained earnings. So I assumed that opening balance of equity share capital and other reserves will be the same. Okay, so I know the opening equity and closing equity. Then come to the question. So R Limited has, so they are giving further information, just very returns. R Limited has credited the dividend received to its retained earnings. So whatever the dividend received, it has to be received in the retained earnings. Then fair value of plant and machinery as on 1st October 2001 was 4 lakh rupees. So this is useful in fair value adjustments. Then rate of depreciation on plant and machinery 10%. Following are increase on the comparison of fair value as per respective Ind AS with book value as on 1st October 2001, which are to be considered while consolidating the balance sheets. So they are giving the fair value of some assets and liabilities as on the date of acquisition. So trade payables 20,000, land and building 2 lakh, and inventories 30,000. So it may be assumed that inventory is still unsold on the balance sheet date and the trade payables are not yet settled. These are the notes. Also assume that other reserves as on 31st March 2002 are the same as 1st April 2001. Prepare the consolidated balance sheet. So they are not giving information regarding other reserves on the opening date, right? So they are saying that assume the closing date other reserves and opening date other reserves will be equal. So now consolidated balance sheet, how I should prepare first. So I purchased the 60% of Krishna Limited, right? So because it is showing as an investment in the SFS, so I can take the investment in Ram Limited from the balance sheet of Ram Limited 8 lakh rupees. So I need to find out the INA. What is the date of acquisition? 1st October 2001. First step, calculation of fair value of net assets on the date of acquisition. How I am finding out? First, balance sheet date mean closing date
equity share capital, other reserves, retained earnings. I have taken from the balance sheet. So 4 lakh, 2 lakh and 1 lakh 64,000. Then I need the opening date like 1/4/2001 equity details. So they are giving retained earnings on 1/4/2001 is 60,000. For remaining two, I assumed it has been same as like a closing date balance. So I have taken 4 lakhs and 2 lakhs. So this is opening equity. This is closing equity. What is the formula for the total profit? The formula for the total profit equal to closing equity minus opening equity. So closing equity minus opening equity equal to profit. This is the total profit. So I need to segregate between pre-acquisition profit and post-acquisition profit. So before going to that, they are mentioning in question, dividend is there, 10% was paid out of retained earnings. So out of this total profit has been arrived after reduction of 40,000 dividend amount. So I need to add the dividend amount of 40,000 to know the exact profit, to know the total profit earned before the declaration of dividend. So I have included 40,000. How you got 40,000? They are saying 10% as the dividend. What is the share capital? 4 lakh. 4 lakh into 10%, 40,000. Then 1,44,000 is the total profit. I need to allocate between pre-acquisition and post-acquisition. So what is the pre-acquisition period? 1st April to 31st September. 1st April to 31st September, 6 months. And post-acquisition period 1st October to 31st March, because date of acquisition is 1st October. Then 1,44,000 minus 72,000. 1,44,000 for 12 months. For 6 months, 72,000. Deduct it. Then I got the post-acquisition profit. Then come here. Date of acquisition. Sorry. This is opening equity. 6,60,000 is the opening equity. I need to add pre-acquisition profit to get the equity as on the date of acquisition. So pre-acquisition profit is 72,000. So total 7,32,000 is the equity on date of acquisition. So if I want to the fair value of the net assets, I need to add the fair value adjustments to the equity on date of acquisition. Equity on date of acquisition is 7,32,000. I need to do the fair value adjustments. Then come to working note number 1. Now I want to know the fair value on the date of acquisition and carrying value on the date of acquisition. So then I got the fair value adjustment. So in question itself, they are giving following are the increases on comparison of fair value with book value as on 1st October. So there is an increase of these amounts are the increased amounts and compared with the book value. So the amount given 2 lakhs is an extra amount and 30,000 is the extra amount for the inventory. For the plant and machinery, they are giving differently information. The fair value of the plant and machinery is 4 lakh rupees on 1st October 4 lakh. So fair value on the date of acquisition 4 lakh. How I need to find out the carrying value on the date of acquisition? In balance sheet, they are giving the carrying value of the plant and machinery as 3,60,000, but this carrying value is on the 31st March. But I want to the carrying value on date of acquisition, that is 1st October. So carrying value On 31st/3/2002, carrying value is 2,70,000. So they are mentioning depreciation for the plant and machinery is 10%. So first, step 1, first I need to find out the carrying value on opening date 1/4/21. So 2,70,000 divided by 90%, then it becomes 3 lakh rupees. Then come to step 2, 3 lakh minus 5% because the time period is 6 months from 1/4/21 to 1st October 21. So 3 lakh minus 5%, I got 2,85,000. So this is the carrying value of the plant and machinery on date of acquisition. So I can substitute this value over here, 2,85,000. What is the fair value adjustment? Fair value on date of acquisition minus carrying value on date of acquisition. So this is fair value adjustment 1,15,000. For the remaining assets, they are giving directly. Then come to trade payables. For trade payables also, they are given in the question 20,000 is the increased amount when compared with the book value. Then I need to do the depreciation adjustment also. I know the fair value of the plant and machinery on date of acquisition 4 lakhs has been given in the question. So 4 lakhs on 1st October 2001. So fair value on 1/10/21. Now I need to know the fair value of plant and machinery on 31st/3/2022 because I need to prepare the consolidated financial statement on 31st/3. So 4 lakh minus 5% is the depreciation rate, right? So depreciation rate is 10% per annum, 5% per 6 months. So 4 lakh minus 5% is 3,80,000. So what is the excess depreciation? So what is the depreciation for 6 months? 4 lakh minus 3,80,000. The depreciation is 20,000. Here 2,85,000 minus 2,70,000. The depreciation is 15,000. But I am recording the values at fair value, right? So generally in separate financial statements, the depreciation has to be recorded is 15,000. But in consolidated financial statements, I will record it at fair values. So my depreciation should be recorded at 20,000. Already in SFS they have recorded 15,000. I should record the excess depreciation of 5,000. Because of this excess depreciation, what will happen? So this excess depreciation treatment should be given over here by deducting from the overall profit, because from the post acquisition profit I should deduct this 5,000 rupees because this is an excess depreciation. So 72,000 minus 5,000, I got 67,000 rupees. This is post acquisition profit. This post acquisition profit has to be allocated to RAM Limited and NCA. Please don't ask what is NCA. I already briefly discussed in the previous session, that is business combinations. So I got RAM Limited post acquisition profit and NCA post acquisition profit. Then come here. So after giving a fair value adjustments to the fair value of equity on date of acquisition, I got the fair value of net assets on date of acquisition 10,57,000. So I got the fair value of net assets on date of acquisition. I got the PC also. What is the PC? PC amount is 8 lakh. So it will be easy for me to find out the NCA and goodwill. So come to step 2, calculation of NCA and goodwill. So what is the PC? 8 lakh. So NCA 40%. So INA 100%. 10,57,000 I have taken from here. 10,57,000. Then for calculation of NCA, I am using the INA method because it is a default method. So 10,57,000 into 40%, 4,22,800. Then I got the goodwill of 1,65,800. Come to step 3. So I know the NCA as on the date of acquisition, but I am preparing the consolidated financial statement. So now I want to calculate the NCA on the date of reporting, that is closing date. So calculation of NCA on balance sheet date. So what is the NCA and date of acquisition? 422 For to this, there is a post acquisition profit. Post acquisition profit allocable to NCA is 26,800. So I should add this amount to the NCA. So 26,800. Then I should deduct dividend portion because I have included this dividend while calculating the total profit, right? So I have included this amount, right? So I should deduct from now because this dividend has been already received, but I have just included to know the exact profit. To know the exact profit, so I should deduct it from here. So dividend 16,000. What is 16,000? Total dividend is 40,000. But what is the proportion of the dividend to the NCA? 40,000 into 40% is 16,000. Deduct this dividend because this dividend is already included in the post acquisition profit. Now I should deduct it. So 4,22,000 plus 26,800 minus 16, 433,600 is the NCA as on the date of acquisition. Then step 4. I need to find out the equity and the balance sheet date. I need to find out the equity and the balance sheet date. So I need to find out the equity of RAM Limited because the consolidated financial statement has to be prepared in the books of RAM Limited. So take the closing equity as per the separate financial statements of parent company. Parent company equity share capital 10 lakh and other reserve 6 lakh and retained earnings 114,400. So 10 lakh, 6 lakh, 114,400. For this I need to add the post acquisition profit acquired from the subsidiary company. So what is the post acquisition profit? The post acquisition profit of RAM Limited portion is 40,200. So add it. So I have added to the retained earnings. From this I need to deduct the dividend portion because this dividend portion already included in 40,200. So 40,000 into my share is 60%. So 24,000 should be deducted. So then I got the equity on the balance sheet date as per the consolidated financial statements. This is 10 lakhs, 6 lakhs, and for the retained earnings it becomes 1,30,600 because retained earnings as per separate financial statements 114,400 plus the retained earnings provided by the subsidiary company. So total retained earnings of the group is 130,600. Then step 5, balance sheet. So we need to be very careful dealing with these red color figures. Okay. Then land and building, plant and machinery. So open it. Land and building 3 lakh rupees. Here use 3 lakh and come to 3,60,000. But I need the fair value, right? Because I should record the fair value of assets and liabilities of the subsidiary company. So what is the extra amount to get the fair value? 2 lakhs for land. So adding the 2 lakhs for the plant and machinery, 4,80,000 is the for the plant and machinery 4,80,000 is the RAM Limited balance. What is the Krishna Limited balance? You are not supposed to take 2,70,000 because it is not fair value. Then what is the fair value? So the fair value has been calculated here. So the fair value of plant and machinery as on closing date is 3,80,000. So 3,80,000. Then inventory. So taken from the two figures from the balance sheet, this 30,000 is excess inventory because of the fair value. So 30,000 should be added. Then goodwill 165,800 taken from this calculation of goodwill 165,800. Now trade receivables and cash, there is no fair values, right? So simply added the both the values of the companies. Then we will got the total assets 24,73,200. And come to equity and liabilities. What is the equity share capital? What is the other reserves? What is the retained earnings? In step 4, we find out the each and every aspect, right? So simply taking the figures from the step 4. So equity share capital 10 lakh, other reserve 6 lakhs, and retained earnings 130,600. Then what is the NCA? From step 3, we can get the closing NCA as on the reporting date, 4,33,600. Then bank OD 1,60,000 plus 0, because there is no bank OD for Krishna Limited. So 1,60,000. Then come to trade payables, 94,200 for Ram, 34,800 for Krishna, but they are giving the fair value is 20,000 is excess of book value. So book value is 34,800. To get the fair value, I should add a 20,000. So this is the fair value of Krishna Limited. So this Ram Limited. So you should add it both. Then I got the 1,49,000. So this is the total for the liabilities. So this is the way to draft the balance sheet of consolidated financial statements. Okay, just observe the process and steps. Just remember these steps. Applying these steps in calculation of any problem, then you can get the answer. So first step is calculation of fair value of net assets on the date of acquisition. For this, I need to use the closing equity and opening equity. So closing equity minus opening equity, I got the total profit. Total profit has to be segregated, post acquisition profit and pre acquisition profit. So opening equity, I already known that because it has been given in the question. Opening equity plus pre acquisition profit equal to, then we got the equity as on the date of acquisition. So after getting the equity on the date of acquisition, we need to find out the fair value of net assets on the date of acquisition. So equity on the date of acquisition plus fair value adjustments, then we can get the fair value of the equity, that is fair value of the net assets. Then we know the PC. How? Because in separate financial statements, the PC is reflected as a investments in subsidiary company. We can take it from the balance sheet. Then third step, we know the PC and we know the identified net assets. So third step is calculation of NCA and goodwill, and you know the how to calculate it. Then the difficult part is fair value adjustment in this sum. So if any asset is given and they are giving depreciation also, just follow the same steps. Here one should remember 2,70,000 is the closing balance. I need the balance as on date of acquisition. Don't do that 2,70,000, right? So I need the balance of on date of acquisition. 2,70,000 divided by, if you do 95%, it becomes wrong. So don't do that. Follow these steps what have mentioned in the question. So 2,70,000. So find out the value on opening date by using this closing date. So this is the step 1. After that, from this arrive with the figure of as on the date of acquisition 2,85,000. So step 1, 2,70,000 divided by 90%, then 3 lakh will come. After that 3 lakh minus 5%, I got the 2,85,000. This is the carrying amount of plant and machinery on date of acquisition. Then 4 lakh is the fair value of the plant and machinery given in the question. From this I need to find out the fair value as on the closing date of the plant and machinery. So 4 lakh minus 5% is the depreciation for 6 months. Then from this I need to deduct excess depreciation. If you follow the carrying amount, 15,000 is the depreciation, but I am following the fair value amounts. So the depreciation amount should be 20,000. So already 15,000 has been passed. So I should add the excess depreciation of 5,000. So because of this excess depreciation, the profit should be reduced. So that's why I have deducted this depreciation amount from the overall profit. Sorry, post acquisition profit. Then come to second one from the super 50. So I will explain illustration 2 at later. So come to illustration 3. So prepare the consolidated balance sheet of group of P Limited, Q Limited and R Limited. In the first illustration, there is only one subsidiary. In third illustration, there is two subsidiaries, Q Limited and R Limited. So they are asking the consolidated balance sheet of group of P Limited, Q Limited and R Limited. So CFS consolidated financial statement has to be prepared by the parent company for all its subsidiaries. So how many subsidiaries are there in the question? Q and R, 2. Then first step, I need to observe the investments because investments reflects the PC. In P balance sheet, separate SFS, investment in Q 80% is 480. So what is the PC paid by P to the Q for acquiring 80% shares? 480. And come to QSFS. In QSFS, investments in R 75% is, it is showing 300. So for acquiring 75% of shares in R Limited, Q paid 300 as a consideration. So I got the considerations of the both the companies. Now so I know the PC. So this is called PC. Then now I want to observe the equity because I need closing equity. So this is equity. So equity, share capital and other equity. Then apart from the closing equity, I need opening equity also. So I need to look for the opening equity. So here they mentioned that on 1/4/20, the balances of other equity were for the Q 100 and R 50. So for Q 100 and R 50, these are the opening equities. Opening equities. I want closing equity and opening equity for calculation of total profit. Then we will look into further information. The control was acquired on 1/10/20 when the fair value of PP was in excess of carrying amount by Q50 and R30. They are giving the information regarding Q and R. So the fair value of PPE of Q is excess of 50 than its carrying value in respect of R excess of 30. So it will be useful in fair value adjustments. Then the new point here is inventory of Q included 16 purchased from R at cost plus 33.33%. So R Limited sold the goods to the Q Limited. So out of the this goods, Q Limited sold everything except 16. So 16 worth of goods still included in the inventory of Q. These 16 goods has been purchased from the R at cost plus 33.33%. So I need to eliminate the unrealized profit because I am showing the group performance. For showing group performance, I need to eliminate the unrealized profits because this transaction is happened between Q and R, right? So the R is recording the profit by selling it to Q. So as a group, it is nothing but selling to its own. So in that case, I am not supposed to record the profits with respect to this transaction. Then bills receivable of R includes 30 from P and bills receivable of R includes 40 from Q. So bills receivable of R includes 30 from P and 40 from Q. This has to be netted off because it is intercompany owings. For preparation of consolidated financial statements, these intercompany owing assets and liabilities should be netted off. Then come to preparation of consolidation financial statements. What is the step 1? Step 1 is calculation of fair value of net assets on the date of acquisition. So P Limited acquired Q Limited by paying 480 lakhs for the 80%. So the date of acquisition 11020, and P Limited acquired 75% of R Limited at 300 lakhs on 110/2020. This is the info given in the question. Then come to step 1, calculation of fair value of net assets on the date of acquisition for P and Q. So I am doing for the fair value of net assets on the date of acquisition. The transaction happened between P and Q. So what is the closing equity of Q? So the closing equity of Q 500 and 160. So 500 and 160. What was the opening? Opening I assumed as same as closing, and for the other equity they are mentioning 100. For other equity, so opening equity, for other equity they are mentioning 100. So I have taken 100. So closing equity minus opening equity, I got the profit. So this profit has to be allocated to pre-acquisition and post-acquisition in the proportion of time. 6 months for the pre and 6 months for the post. So 60 by 12 into 6 means 1/2. So 30 for the post and 30 for the pre. So this is equity and date of acquisition plus pre-acquisition profit. I got the equity on the date of acquisition. To this I need to make some fair value adjustment. What is the total fair value adjustment with respect to Q? With respect to Q, fair value adjustment is 50, because it is excess of 50 than its carrying value. Just add this 50 rupees to the carrying value. Then I got the fair value of net assets on the date of acquisition. Then come to profit side. This is post acquisition profit, right? This post acquisition has to be transferred to parent and NCA in proportion of the respective. So 80% is 24 and 20% 6. So this transaction happened between P and Q. Come to P and R. So what is the R closing equity? The R closing equity is 301. Opening equity 50. Sorry, opening equity of R 50. Then so 300, 120 closing, and 50 is the opening. Assume that opening and closing is the same for equity share capital. Then I need to eliminate the unrealized profit. What is the unrealized profit? So goods actually sold by R. So the profit element is included in the RSFS. So in RFSS, I need to eliminate the unrealized profit. What is the unrealized profit? So there is a total 16 is the sale price. Here the profit is mentioned and the cost 1/3 on the cost. So on sales 1/4. Here they are giving sales. So 16 into 1/4. I got the 4 is the unrealized profit. So I have deducted from the 70. So I got 66 is the total profit. This has to be allocated to pre-acquisition and post-acquisition. 33 and 33. So total profit minus pre-acquisition, I got post-acquisition. Here equity on date of, so equity, opening equity plus post-acquisition profit, I got the 383. This is equity on date of acquisition. I need to make some fair value adjustment, then only I get the fair value of net assets on the date of acquisition. So fair value adjustment is 30 for R. Then come to calculation of NCA and goodwill or GPP for P and Q as well as for the P and R. So what is PC? 480 lakhs. It has been given PC 480 lakhs and here PC 300 lakhs. So here PC 480, here 300 lakhs. What is the NCA percentage? 20. Here 25%. I will use the fair value method. Here they are using the fair value method. Why? Just check whether they have mentioned anything regarding the fair value calculation. Sorry, NCA calculation. Yes, NCA is measured at fair value. So 480 divided by 80 into 20. So NCA got 120. Here 100. So what is the identified net asset? 680. So 680 from this calculation and 413 for P and R identified net assets. Then I got the gain on bargain purchase 13 lakhs. Here 80 lakhs for the P and Q. Then I need to find out the closing NCA for both the transaction. What is the NCA and date of acquisition? 120. Here 100. Then what is the post acquisition profit? The post acquisition profit for the NCA portion is 6 here and here 8.25. So 6 plus 6 and here 8.25 total. Closing NCA as on the closing NCA as on the reporting date 126 lakhs and 1 at 8.25. Come to find out the calculation of closing equity. What is the separate financial statement, equity share capital and other equity balance of parent company? So parent company equity share capital and other equity 600 plus 460. 600 460. And what is the post acquisition profit from Q? 24. The post acquisition profit from R 24.75. So 24 taken from here. Sorry, 24 taken from here and 24.75 taken from P and R. So 24 plus 24.75. Total I got the other equity amount 508.75. Then come to the balance sheet. 400 plus 500 plus 320 is the amounts taken from the balance sheet. This 50 and 30 are the fair value adjustments. So I need to add it 50 plus 30 to make it to the equal to the fair value. Then it becomes total 1300. So comes to inventory part 250 plus 80 plus 60. But I need to eliminate the unrealized profit. What is the journal entry for the unrealized, for the elimination of unrealized profit? P&L account debit to inventory account. So profit need to be reduced by 4. So that's why I have deducted 4 from here. Then inventory also should be reduced 4 rupees. So that's why I have deducted 4 rupees here. And come to trade receivables, just taken from the values from the balance sheet, and come to bills receivable 70 plus 50 minus 30 and 40 are the interwoven adjustment, because this 30 has to be received from P and 40 from Q. Okay, then 70 plus 50 minus 30 minus 40. Intercompany adjustment has to be eliminated. Then cash and bank 150 plus 50 plus 60. Sorry, 180 plus 50 plus 60. Then come to equity share capital taken from the step 4. Other equity also step 4. So step 4 600 and 508.75. Then gain on bargain purchase taken from the step 2. What is the gain on bargain purchase? Here 80. Sorry. Here 80 and here 13. 18 plus 13 equal to 93. And NCA taken from the step 3, because I need the closing NCA. The closing NCA is 126 plus 108.25. So 234.25. Then trade payables, just take the values from the balance sheet, and dividend payable is 50. And come to bills payable. Here I have eliminate the bills receivable, right? So for bills payable also I need to eliminate this 30 and 40, because it is intercompany owings, because it is bills receivable for one company and these are bills payable for another company in this group. So that's why I have deducted this amount. So the balance sheet amount is 2626, here 2626. Then under some illustration, what is the illustration number? Illustration number 4 from the Super 50. So prepare the consolidated balance sheet as of 31st March 2002 of group of companies comprising P Limited, S Limited and SS Limited. The first problem is one parent company, one subsidiary, and the second one is one parent company, two subsidiaries. Here also one parent company, two subsidiaries, but this is chain holding. So P Limited has acquiring control in S Limited, and S Limited has shares in SS Limited. So indirectly P Limited controls SS Limited also. This is called chain holding problem. So this is the balance sheet. Whatever is the type of the problem, my steps will remain the same. Okay. So I need first investment. So what is the investment? 32 lakh equity shares and 24 lakh shares in SS Limited. They are not mentioning the percentage. We need to calculate the percentage shareholding by using this 32 lakh shares and 24 lakh shares. Then, so this is PC. So P Limited paid to the S Limited for acquiring 32 lakh shares in S Limited. So 340 is the PC. Then come to S Limited. In S Limited balance sheet, the PC is 280 because S Limited paid 280 lakhs for acquiring 20 lakh shares in SS Limited. Then come to equity share capital. So share capital and other reserves will be so this is closing capital because the capital this is closing equity. So equity on the balance sheet date. So 400, 150, and 320, 80, 60. So after that I need the opening equity. So other mentioned any information regarding opening equity? Yeah. So on 1st April 2001, the following balance sheet stood in the books of S Limited and SS Limited. So these are opening equity. So it is opening equity. Let's check further information. The further information is P Limited holds 80% shares in S Limited and S Limited holds 75% shares in SS Limited. So their holdings were acquired on 30th September 2001. What is the date of acquisition? 30th September. Then business activities of all the companies are not seasonal in nature, and therefore it can be assumed that profits are earned evenly throughout the year. So the profits are allocated between post acquisition and pre acquisition based on the time, because he is assuming that profits are evenly earned throughout the year. Then 1st April 2001, the following balances stood in the books of S Limited and SS Limited, and it is the opening equity. Then 10 lakhs included in the inventory figure of S Limited. So it is standing in the inventory of S Limited. Let's see from whom this inventory is coming in the books of S Limited. So is inventory which has been purchased from SS Limited at cost plus 25%. So it has been purchased from SS Limited. So the sale is made by SS Limited. So the profit is in the books of SS Limited. So this is unrealized profit. I need to deduct it from SS Limited profit. Then come to the parent company has adopted an accounting policy to measure the non-controlling interest at fair value. At which value? At fair value. Then he's mentioned quoted market price. Fair value by using quoted market price. Applying Ind AS 103. So there is an assumption. Market prices, assume market prices of S Limited and SS Limited are the same as respect to face values. So what are the market values of S Limited and SS Limited? Their face values. And come to BC notes. Here under fair value method there are two subclassifications. If fair value of the share is given, I need to follow the NCA shares. I need to find out the how many number of shares for the NCA and into fair value of acquired share. So here in the question itself he has mentioned they are following fair value method by using quoted market price. So they are following first one. So in this first one I need to find out the NCA shares into fair value of the acquired share. Are they given the fair value? Yes. Assumption is the fair value means market value is as same as face values. So in the calculation of NCA, I need to use the fair value method and type 1. Type 1 means NCA shares into face value of the share, because here fair value and face value is the same. Then come to the problem. In this one they are mentioned only number of shares, right? So 32 lakh shares, 24 lakh shares. First step is I need to find out the percentage of holding. So total number of shares in S Limited is 40 lakhs. Out of 40 lakhs, 32 lakhs purchased by P Limited. And come to SS Limited. In SS Limited, the total number of shares 32 lakhs. So out of 32 lakhs, 24 lakhs purchased by S Limited. So I need to find out the percentage holding. So 32 lakhs, total 32 lakhs, total 40 lakhs. Out of 40 lakhs, 32 bought by P Limited. So 32 divided by 40 into 100, 80%. So P Limited purchased 80% of shareholding of S Limited. And come to second one, percentage of calculation equal to out of 32 lakhs, S Limited purchases 24 lakhs of SS Limited. So 24 lakh divided by 32 into 100. So 75%. So S Limited purchased 75% shares of SS Limited. So this is an example for chain holding sum. So P Limited acquired 80% in S Limited. So S Limited acquired 75% in SS Limited. So indirectly P Limited acquired 60% of shareholding in SS Limited. So how they are holding? They are holding through S Limited. So 80% into 75% equal to 60%. So P Limited has the got control of 60% of SS Limited. It is called chain holding. We are holding the interest not directly by our subsidiary. So P Limited effectively holds 60% of SS Limited. So P Limited, PC 80%, 340 lakhs. How you are getting this PC? So 340 lakhs. From separate financial statements, investment 340. This is the PC. And here 24 lakhs, 280 is the PC. Come here. So the PC is 60% because effectively in SS Limited, P Limited holds only 60%. So what is the purchase consideration paid by S Limited to SS Limited? Total 280 lakh paid by S Limited. So in S Limited, my holding is 80%. It means if 100 rupees earned by S Limited, my share is 80%. So if 100 rupees expenditure is made by the S Limited, out of 100 rupees, my share is 80 rupees. Here X Limited paid 280 lakhs. Out of 280 lakhs, what is my share? What is the amount paid by me indirectly? So 280 lakh into 80%, 224 lakhs paid to SS Limited by P Limited indirectly. So PC 60%, 224. Now I need to find out the identified net assets, and the rest is as same as illustration 3 and illustration 1. So calculation of fair value of net assets on the date of acquisition. First we will find out for P Limited to S Limited. So what is the closing balances? 100. So 400, 150. The equity share capital, reserves and retained earnings have taken from the balance sheet. This has been taken from the opening balances given in the question. Then, so closing equity minus opening equity is total profit. So 50 is the total profit and 500 is the opening equity. So 50 has to be allocated between pre-acquisition and post-acquisition period. So 50 divided by 12 into 6 months, 25 into 25. So opening equity plus pre-acquisition profit equal to equity on the date of acquisition. So 500 plus 25, 525. So total profit minus pre-acquisition profit, I got the post-acquisition profit. Is there any fair value adjustments? There is no fair value adjustment. So 525 plus 0 equal to fair value of equity. This is carrying value of equity on the date of acquisition. This is fair value of equity on the date of acquisition. This is also known as fair value of net assets on the date of acquisition, 525. So this post acquisition profit has been allocated between parent and NCA. Parent share is 80%, NCA share is 20%. Then come to parent to SS Limited. So what is the effective percentage? 60%. Come to P Limited to SS Limited. These are the closing balances taken from the balance sheet. Closing equity of SS Limited. Then opening equity of SS Limited. So what is the total profit? 50. And what is the opening equity? 410. So there is unrealized profit because it has given information 10 lakhs included in S Limited, but it has been purchased from SS Limited. So I need to deduct the unrealized profit from the SS Limited. So SS Limited profit is 50. So I have deducted 2 rupees. So what is the amount? 48. So 48 has to be allocated between pre and post. So 24 into 24. So how this 2 is arrived? They're mentioning 10 lakhs is the closing inventory left in the stock of S Limited. So they're mentioning 1/4 on the cost. So 25% on the cost. So 1/4 on the cost. Then 1/5 on the sales. 10 lakhs is the sales, right? So 10 lakhs into profit percentage 1/5. So I got the 2. Then come to equity on the date of acquisition. So opening equity 410 and pre-acquisition profit 24. I got the equity on the date of acquisition. Then total profit minus pre-acquisition profit, post-acquisition profit. So post-acquisition profit has to be allocated to P Limited and NCA in the proportion of 60% and 40%. Then fair value adjustment is 0. So fair value of equity or fair value of net assets on the date of acquisition is 434. What is the step 2? Calculation of NCA or goodwill and GPP. So PC 80%, 340 paid by him, and NCA, this is very important. The NCA calculation is important. So I need to use fair value method type 1. So for that I need to find out the how many shares for the NCA. So total shares in S Limited 40 lakh shares. So NCA percentage is 20. So 40 lakh shares into 20% into market price per share. Here market price is equal to face value. So I have taken 10 rupees. So it is. So don't use the type 2 in the fair value method. Type 2 means 340 divided by 80 into 20. So don't use that method. Use the first one. Use the first one. Then identify net assets 525 lakhs. Identify net assets 525 lakhs. Then P to SS Limited. So what is the PC amount? 224. How this amount got? Total paid by S Limited is 280. Out of 280 expenditure, my share is 80%. So I write down it as 224 lakhs plus NCA. How many shares are there in SS Limited? Total 32 lakh shares will be there. So out of 32 lakh shares, what is the NCA portion here? 40% into 40 into face value is the market price. So into 10, NCA is 128 minus identified net assets 434 taken from step 1, identified net assets 434. So what is the GBP here? 82 lakhs. Here NCA calculation is important because I need to take the total 32 lakhs into 40% only. So don't do that 25 percentage. So just follow the percentages here, and later on we will deduct the extra portion of NCA. Don't worry. Then calculation of closing NCA. NCA and date of acquisition 80, and here 128. So post acquisition profit 5 lakhs, 9.6 lakhs. Post acquisition profit 5 lakhs for NCA and 9.6 lakhs for NCA. So total 85 and 137.6. Out of this total NCA, I should deduct the NCA share of investment in SS Limited. Here I will take 280 into 80% is the PC for the 224, and remaining 20% is NCA, right? Generally, so that NCA I should be recorded, but instead of that I have recorded NCA to the extent of 40%. That why I should deducted 20% NCA. So 280 into 80% here they are used, so remaining 20% I should be deducted. So 280 into 20% should be deducted from the total NCA. So the closing NCA is 166.6. Step 4, calculation of CFS equity of the parent. Who is the parent here? Parent is P Limited. So what is the equity share capital, reserves and retained earnings as per the SFS? 600, 180, 160. 600, 180, 160. From this, post acquisition profit of S 120 and post acquisition profit of SS 14.4. So this is the consolidated financial statements 600, 180, 194.4. Just substitute all the values from the balance sheets. So here the important point, inventories. From the inventories I should deduct the unrealized profit, because the journal entry for the elimination of the unrealized profit is P&L account debit to inventory account. So I need to deduct 2 rupees from the profit. That's what I did in the step 1. And second, 2 rupees has to be deducted from the inventories. Then rest is the same like illustration 1 and 3. So equity share capital 4, step 4, and NCA has been taken from step 3, and GBP step 2. So total is 2308. So the total is 2308. The answer is here 2208. We are getting 2308. The difference of 100 rupees is due to the intercompany borrowings, because in answer they got 2208, but here we got 2308. So the difference is due to 100 rupees of intercompany borrowings. So we haven't taken into consideration. Let's see here. So bills payable in S Limited 70. This 70 rupees has to be received from P Limited, and this 30 rupees in P Limited. In P Limited, the bills receivable is 30, but this 30 rupees has to be received from SS Limited. So these are the intercompany borrowings 100 rupees. So I should be deducted from the bills payable and as well as bills receivable in asset side. So what are the bills receivable here? Minus 100, because it is intercompany borrowings. So 2 rupees. Then the answer is 2208. Then come to liability side. In bills payable, I should deduct 100 rupees. Then the answer is 2208.
So okay, so please do these three sums repeatedly, so you may get one problem to the in the exam. So if you got similar type of sum, you can get easily 14 marks. So don't leave the chapter, just see the basics. If it is possible, you can do it in exam. Depends on the situation. Okay. There is some theory regarding with this chapter. So as per the Companies Act, every company shall prepare consolidated financial statements of its subsidiaries and associates. But there is an exception to this rule. Investment entity no need to prepare CFS, provided investment entity value its investments at fair value transferred through P&L as per Ind AS 109. So fair value transferred through P&L. Then come to investment entity. What is meant by investment entity then? Investment entity means if it obtains funds from the investors, and the main principal business is to invest funds for the returns. And the third one is measure investment at fair value. With these three conditions are satisfied, we can call that entity as an investment entity. Then come to the concept of joint arrangement. What is meant by joint arrangement? Joint arrangement means in which the parties are bound by the contractual arrangements which gives control to two or more parties. So it is a contractual arrangements. With this contractual arrangements, the joint control is given to two or more parties. Then it is called joint arrangements. Here one word is there, joint control. What is meant by joint control? If you take any decisions, we need unanimous consent. Unanimous means we need the consent of all the parties who are sharing control in the joint arrangement. Then now joint arrangement is classified into two types, joint venture or joint operation. So it depends on several conditions. Let's check few conditions. If joint arrangement is a separate entity, then in that case we need to check further conditions for the classification of joint operation or joint venture. If it is a joint operation, the accounting treatment is done by as per Ind AS 111. Then if it is a joint venture, and we know that the joint venture accounting treatment is dealt by Ind AS 28. So under joint venture, so we have the right on net assets and equity. In the joint venture, we have the right on net assets or equity. Then if the joint arrangement is not a separate entity, in that case we can directly classify it as a joint operation, and the accounting treatment is as per Ind AS 111. In joint operations, the accounting treatment is we have right to assets and obligations to liabilities. In joint venture, we have right on net assets or equity. So this is the major difference between the accounting treatment of Ind AS 28 and Ind AS 111. Then come to Ind AS 112, disclosure of interest in other entities. So there are four aspects. What information we should be disclosed? So we need to disclose the information regarding the interest in other entities. So there are four important points. Disclosure of information about the performance and disclosure of significant transactions with other entities. Third one is significant judgments and assumptions. Fourth one, interest in subsidiaries, joint arrangements and associates. Okay. Then with regard to the subsidiaries, associates and joint arrangements, what are the disclosure requirements? What information need to be disclosed as per Ind AS 112? So regarding with subsidiary and associate, we need to disclose the nature and extent of control. Second one, we need to disclose the proportion of ownership interest. Third one, potential risks. Then come to joint arrangements disclosure requirements. We need to disclose the type of joint arrangements. There are two types of joint arrangements, right? Joint operation or joint venture. I need to disclose whether this joint arrangement is a joint operation or joint venture. And the remaining 2 points same. We can write it from there. Proportion of ownership interest and our potential risk. These are the disclosure requirements as per Ind AS 112. Okay. The next topic is recent developments in financial reporting. So before going into this, let's see some weightage from the past paper examinations. So coming to 7A question, June 24, December 23 and June 23, and the syllabus is 2022. So in 7A question, in every attempt for the last 3 years, the question is coming from recent developments in financial reporting. So in recent developments in financial reporting, in 7A, one practical question will be coming. So last attempt EVA, before that value added statement, before that again EVA. So this time I am expecting value added statement. So 7A is for the practical subject, for the practical problems of recent developments in FR. Come to 7B question. In 7B question also, one question is coming from recent developments in FR, but not from the practical aspects, but from theory aspects. Last attempt, CSR Rule 8. The question is CSR Rule 8. And before that, integrated reporting objectives. And before that, it is coming from the government accounting. So in 7B, one theory question is asking from this chapter, and in 7A, one practical question is asking from this chapter. So let's discuss the practical aspects first, later then look into the theory aspects. So recent developments in FR. So practical topics. There are 3 practical topics in this subject, this chapter. So value added statement and economic value added and market value added. So let's first discuss with the value added statement. So what is value added statement? It means it's a statement showing how much the company is generating from the core operations of the business. By looking at this statement, we can know the how much the company is generating from the core operating business. So this is the format for value added statement. So creation of value added and distribution of value added. So in creation of value added, there is 4 subcategories. In distribution of value added also 4 categories are there. So first one, sales. Second one, income from services. Third one, cost of bought in materials. Fourth one, cost of bought in services. These are the 4. These 4 for creation of value added. So how we get the creation of value added? Sales plus income from services minus cost of bought in materials minus cost of bought in services. Then we got the added value created. So A plus B minus C minus D. Come to distribution of value added. The value added is distributed to different persons who are there. To the employees and to the government and to the providers of the capital. And then the 4th one is retained earnings. So we can add these 4 aspects. We can got the disposal of value added. Then let's pick a question from Super 50. So here the question which has been given in the Super 50. So the following are the balances in the account statements of X Limited for the year ended. So turnover, plant and machinery, loss on sale of machinery, depreciation, dividend, debtors, creditors, and total stock of materials, opening stock, closing stock, and raw materials purchased, cash at bank, printing and stationery, auditors remuneration, and retained profits for the year. They are giving opening balance and the current year. And rent, rates, taxes, other expenses, and they are giving ordinary share capital issued, interest on borrowings, income tax, wages and salaries, ESI, employee state insurance, and the last one is PF contribution. By using this info, I need to prepare the value added statement for the company. I know the format for the value added statement. First I need sales. First I need sales, right? So from this I need to take the turnover. So turnover 4,600.
So turnover 4,600. What are the services? Are we getting any income from providing of services? No. Then service part is 0. The next element is cost of bought in materials. So cost of bought in materials, I need opening stock plus purchases minus closing stock. Then only I got the cost of materials consumed during the period. So what is opening stock? Opening stock 300, the closing stock 400, raw materials purchased during the year 1250. Opening stock plus purchases minus closing stock, I got the cost of materials consumed during the year. So 1170. Then cost of bought in services. So let's record the expenses in the P&L account. So what are the expenses here? Rent, rates, taxes, other expenses, printing and stationery, auditor's remuneration. So printing and stationery, auditor remuneration, rents and taxes, other expenses. I need to record it in the cost of bought in services. Sir, why you are not taking wages and salaries or interest? Because it has to be taken in the distribution of value added, not added value created. Then I got the creation of value added. So 4,600 plus 1170 for cost of bought in materials and cost of bought in services 600. So total added value created 6370. Then come to distribution of value added. So distribution of value added is made to four persons: to employees, to government, to providers of capital, and to retained earnings. Come to employees. Is there any payments made with respect to the employees? Yes. Wages and salaries and employee state insurance and PF contribution. So 654, 70, 56. 654, 70, 56. You added, I got the distribution of value added to the employees. And to the government. Next aspect is government. What are the payments made to the government? So here income tax for the year 552. So income tax 552. Then to the providers of the capital. So who are providing capital? Equity holders or debenture holders. So for the equity holders, I will pay dividend. For the debenture holders, I will pay interest. So I need to check for the dividends. Dividend to the ordinary shareholders 292. And what was the interest on borrowings? 80. So 292 plus 80. So 80 for the borrowings and 292 as a dividend. So total 372. Then come to retained earnings. What is retained earnings? In retained earnings part, we got the depreciation and plant and machinery, because it is not original expenses. It is a notional expenditure which we are transferring some part to the P&L for the future purpose, for purchasing asset in the future. So this is retained earnings. So we transfer some part of P&L to the retained earnings, right? So that's why we will call it as a depreciation of plant and machinery, retained earnings. So depreciation, plant and machinery 400. What is the retained profit for the year? For the current year, there is a retained profit. What was that? The retained profit for the year is 576. Please don't take the retained profits of opening balance. So retained profit for the year. Then 400 plus 576, 976. Loss on sale of machinery. There is one aspect, loss on sale of machinery, which I cannot be added in these four parts. So that's why I have recorded separately as like loss on sale of machinery. So 150. This is also need to be added for the arrival of disposal of value added. The answer is 2830. A plus B plus C plus D plus 150. Then I got the 2830. Generally, loss on sale of machinery, there is no need to add it in the value added statement. But specifically in this sum, they have added the loss on sale of machinery. So that's why I also taken into consideration, but I write it as a separate element.
So you also follow the same concept. Loss on sale of machinery is there. Write it as a separate element in the disposal of value added statement. Then the next term is the next concept is economic value added. What is meant by economic value added? So economic value added is a financial metric which measures the company economic profit after accounting of cost of capital. So this is called economic value added. How to arrive economic value added? So NOPAT minus capital employed into weighted average cost of capital. This is the formula for economic value added. NOPAT minus capital employed into weighted average cost of capital. Then come to illustration from Super 50. This illustration is regarding with the computation of economic value added. Let's read it. LG & Co. provides you with the following info as at 31st March 2022. So share capital 1000 and reserves and surplus 2000. Long term debt 200 and sundry creditors 50. Total 3250. Then fixed assets net, it's not gross. So after deducting of accumulated depreciation, so 3000 fixed assets, investments 150 and current assets 100. So total 3250. Additional information provided is as follows. Profit before interest and tax is 1000 lakhs. Then interest 20 lakhs. Tax 35.875. So risk free rate is 10%. Then market rate is 15%. This is called RM. This is called RF. Then what is the beta? 1.4. Now I need to find out the economic value added. So I know the formula for the EVA, NOPAT minus capital employed into weighted average cost of capital. But how we arrive the NOPAT? EB80 into 1 minus T. Earnings before interest and tax into 1 minus T. Then I got the NOPAT. Come to capital employed. Capital employed. Equity plus non-current liabilities. Non-current liabilities means we can call it as a debt. So long-term debt. Equity plus non-current liabilities, we will get the capital employed. Or there is a other alternative for the calculation of capital employed. Fixed assets plus working capital. So fixed assets plus working capital. If you added both these elements, I can get the capital employed. And come to, so the remaining part is weighted average cost of capital. How I need to find out the weighted average cost of capital? KE into, KE means cost of equity into weight of the equity divided by weight of equity plus weight of debt plus cost of debt into weight of debt divided by weight of equity plus weight of debt. This is the formula for WACC, weighted average cost of capital. Okay. Then we need to check with the question whether these elements are available in the question or not. So EB80 here, EB80 is available. Profit before interest and tax. So I can assume it is a earnings before interest and tax, right? So 1000 lakhs. It will be useful for in NOPAT calculation. So NOPAT equal to EB80 how much? 1000 lakhs into 1 minus tax rate. What is the tax rate? The tax rate is 35.875. Tax rate is 1 minus 35.875. Then I got the NOPAT value of 641.25 lakhs. Then capital employed. How we need to find out the capital employed? Go to the balance sheet. Share capital 1000 and the reserves and surplus 2000 and long term debts 200. So I need to add it equity plus debt. So 3000 plus 200, 3200. This is the capital employed. What is equity? 3000. What is debt? 200. Then how to find out the cost of equity? By using CAPM formula, RF plus RM minus RF into beta. So RF is 10%, RM is 15% and beta is 1.4. So RF plus RM minus RF into beta. The cost of equity is 17%.
Come to cost of debt. What is the formula for the cost of debt? Interest into 1 minus t divided by debt into 100. What is the interest here? The interest is 20 lakhs. The tax rate is 35.875. So interest into 1 minus t, 20 into 1 minus 35.875% divided by debt 200. What is the debt portion? The debt portion is 200. So divided by 200 into 100, I got the 6.413. This is cost of debt. Cost of debt is 6.413%. Then come to weight of equity and weight of debt. Weight of equity means equity share capital plus reserves and surplus. I got 3000 lakhs. Weight of debt means there is some long term debt 200 rupees. So long term debt 200. And weighted average cost of capital. Substitute all these values in this formula. K into WE divided by the total capital employed plus KD into weight of debt divided by total capital employed. Then I got the weighted average cost of capital 16.34%. Now I got the WACC, I got capital employed, I got NOPAT. So I got these three elements. Then by using these three elements, I can get the EVA. So what is NOPAT? NOPAT 641.25. Next, what is capital employed? 3200 lakhs. So 641.25 minus capital employed 3200 into weighted average cost 16.34% is equal to 11.37. So economic value added is 118.37 lakhs. Then come to the third concept. The third concept is regarding with the market value added. So what is meant by market value added? The difference between market value and capital employed. So how we got the market value? Market value of equity and debt, like market value of the firm minus capital invested, then we can get the market value added. So these three are the practical aspects in this chapter. Let's go to theory portion. So concepts from the past examination. So whatever the concept here, these has to be asked already there in examinations from 2016 syllabus. These are the questions asked from this chapter. Users of XBRL, applications of XBRL, applicability of CSR reporting, sustainability reporting. So all these questions, all these concepts and questions have been already asked in the past examinations. Which syllabus? 2016 syllabus. Then come to 2022 syllabus. In 2022 syllabus, they are asking about IR objectives. IR means integrated reporting objectives, and CSR rule 8. Corporate social responsibility rule 8. Now, if you read these aspects also, we can get the marks from the theory aspects of this chapter. So there are no 12 concepts. Here the concepts are repeating. Here meaning and benefits of the reporting. So meaning and advantages of sustainable reporting and applicability of CSR reporting. So few concepts are repeating or again and again. So here they are mentioning IR objectives, integrated reporting objectives. So here the benefits of the integrated reporting. So concepts are repeating. If you cover these aspects, then it will be fine. Okay. So first, what are the users of XBRL? Users of XBRL. These are the users of XBRL. What is meant by XBRL? XBRL means Extensible Business Reporting Language. So, who are the users for the XBRL? Companies, NPOs, non-profit organizations, accountants, analysts, investors, regulatory authorities, government agencies and tax authorities, statistical and monetary policy authorities, and specialist data providers. So we can use the XBRL in all these aspects. So we can write it any four. If they are asked what are the users of XBRL, we can rate 5 to 6 points. That's enough. So I can pick companies. So companies required to provide accurate information to stakeholders and streamlined internal communication. That's why they are using XBRL reporting. Then so companies then come to accountants. Support clients in meeting reporting requirements and preparing financial statements in XBRL format. So it will be useful for the accountants for the preparation of the financial statements in XBRL format. Then come to investors. Evaluate potential investments and analyze the performance of current holding. What are the uses? What are the uses of XBRL to the investors? They can evaluate the potential investments. Potential means future investments, and they can analyze the performance of the current holdings. Then go to government authorities. So government agencies work to simplify the business reporting and enhance government reporting standards. And come to tax authorities. Require financial statements for the corporate tax processing and compliance review. So if the financial statements are in XBRL format, then it will be useful in easy processing of corporate tax as well as for the compliance review. So in users of financial statements, I would like to remember 4 points: companies, accountants, investors, government agencies, tax authorities. Total 5. For the companies, for the providing of accurate information. Then accountants, for the preparation of financial statement in the understanding manner to their clients. Then come to government agencies. Sorry, investors are there. For the investors to evaluate the potential investments and evaluate the performance of the current holding. Then come to government agencies. It will be useful in reporting to the government. And tax authorities, if the financial statements are in XBRL format, it will be easy for the processing of the corporate tax and compliance procedures. These are the users of the XBRL. You no need to write every each aspect as per the books. So you can write it as a generally, but you need to understand the concept here. Next. So users of XBRL completed. Applications of XBRL. So what are the applications of XBRL? So XBRL applications. So XML and taxonomy. These are the XBRL applications. XML means extensible markup language. Is a markup language that structures information. What is it is doing? It is structures the information into document and making it both human readable and machine readable. So that information can be readable by humans as well as the machines. Then XBRL is XML based, enhancing compatibility with various software applications. So XBRL is XML based, enhancing compatibility with various software applications. Then come to second XBRL application, taxonomy. So taxonomies are hierarchical dictionaries in XBRL. So these are the hierarchical dictionaries in XBRL that define specific tags. What they are defining? They are defining specific tags for data items, for the net profit or sales or gross profit, some aspect. So it defines specific tags for data items, their attributes and relationships. And different taxonomies cater to verifying reporting needs and are approved by regulatory bodies reflecting local accounting standards and regulations. So what are the uses of taxonomy? It defines the specific tags for the data items and their attributes and the relationships. What they are specifying, what they are defining? They are defining data items, their attributes and relationships. One more thing, cater means serve. So different taxonomies serve to verifying the reporting needs and needs of local regulatory bodies, and it should be reflecting local accounting standards and regulations. These are the applications of XBRL concepts. Then third one. So let's see, is there any XBRL related concepts? Yes, one more thing is there. XBRL. What is meant by XBRL? XBRL means it's extensible business reporting language. So XBRL is a standardized electronic communication language. For what is the purpose of XBRL? For expressing, reporting and filing. So ERP. For expressing, reporting and filing financial information by companies as defined under the company's rules 2015. So every company should file their information to the government in the XBRL format. So what is meant by XBRL? XBRL is a standardized electronic communication language for expressing or for reporting, F for filing the financial information by the companies as per the company's rules. Then next concept, applicability of CSR reporting. So next, corporate social responsibility. So what is meant by CSR? CSR means corporate social responsibility is the commitment of organizations to contribute positively to society, reflecting their accountability towards the well-being of communities and environment. So this concept is introduced with the purpose of contributing positively to the society. Why they are contributing the society? For reflecting their accountability towards the well-being of the communities and the environment. So they invoke one provision to mandate this requirement. So as per section 35, every company should spend minimum percentage of the profits on CSR activities. Sir, what is CSR activities? The CSR activities are as specified in the schedule 7. So the activities specified in the schedule 7 is called CSR activities. We can spend our expenditure on these activities. Then, sir, which companies need to spend their minimum amount as per the CSR requirement? So the applicability of CSR is given in companies rules 2014. The applicability rules and the formulation of the policies regarding the CSR is given in the companies rules 2014. Then, which company CSR is applicable? Any company, any specified company, I will tell you the rules. Then its holding company, subsidiary, and foreign companies with branch or project in India. For all these companies, CSR requirement is applicable. CSR requirement means it has to be spent minimum expenditure towards the society. So the CSR is applicable to the companies whose net worth is greater than or equal to 500 crores and turnover is greater than or equal to 1000 crores. Net profit is greater than or equal to 5 crores last 3 financial years. So if we satisfy any conditions, then CSR is applicable to those companies. Not only those companies, its holding companies, its subsidiaries. And it will be applicable to foreign companies with branch or project in India. And come to CSR committee. So for fulfilling these rules or these requirements, company should have CSR committee. In CSR committee, must at least 3 directors. The CSR committee should have at least 3 directors, out of which at least 1 must be independent director. And what is the role of CSR committee? We are forming a committee, right? Why? What is the purpose of forming this committee? So it's outlining the activities and determining the amount to be spent on these activities. And it also monitor the implementation of the CSR policy, how these is implementing, what are the activities they are undertaken in the future, whether these activities are as per the schedule 7 or not, and determining the amount spent on these activities. These are the duties of CSR committee. Then what are the activities as specified in the schedule 7? Eradicating extreme hunger and poverty, promoting education, promoting gender equality, and empowering women, reducing child mortality and improving maternal health. Then combating diseases like HIV, AIDS and malaria and ensuring environmental sustainability, employment, enhancing vocational skills, supporting social business projects and contributing to national relief funds for socio-economic development, other prescribed activities. These are the activities specified in the Schedule 7. Your corporate social responsibility expenditure should be spent on any of these activities. If you spend on other activities other than these 7, then it is not qualified as the CSR expenditure. So in MCQs, there is some expenditure regarding with the education of the employees. Here they mentioned the education, but the education at large level, it should not be confined to our employees or their families. So these benefits should be provided to the large public. There should not be any discrimination providing of these services to the society. So if you providing to your employees, then it will not be covered under the CSR activities. Remember this part. Then what is the quantum of CSR spending? So I'm saying I need to contribute some amount toward the corporate social responsibility, right? So what is the minimum amount? The minimum amount is 2% of their average net profits for the last 3 financial years. What is the minimum profit? 2% of average 3 last year profits. If you have any unspent amount, that unspent amount has to be transferred to unspent CSR account within 30 days of the financial year end and spent within 3 years. Otherwise, it goes to specified spend under Schedule 7. For the unspent amounts not relating to ongoing projects, transfer to Schedule 7 fund must occur within 6 months of the financial year end. So if you transfer some amount to any project, but that project is still in continuation, but the amount is not yet spended, so that amount should be transferred to unspent CSR account within 30 days of end of financial year. And some unspent amount is there. So we are not transferred for any ongoing project, just some expenditure we haven't incurred. Minimum 2% requirement, right? So we have incurred only 1% expenditure. That remaining expenditure we can transfer to Schedule 7 fund within 6 months of end of financial year. So this is the applicable to CSR reporting. CSR is applicable to companies whose net worth is greater than or equal to 500 crores. Whose net worth is greater than or equal to 500 crores, turnover 1000 crores and net profit greater than or equal to 5 crores last 3 financial years. Then let's see, is there any concepts regarding CSR reporting? So CSR reporting and integrated reporting, and we can write CSR reporting from the points we have discussed earlier. And Rule 8, CSR Rule 8. What is meant by CSR Rule 8? Come to concept number 30. So according to Rule 8 of Companies Rules 2014, companies subject to these rules must include annual CSR report in their board's report detailing the following. So as per the Rule 8, the CSR report should be included in the board's report. Then what is the requirements? What are the requirements of CSR annual CSR report? What information should be there in the annual CSR report? CSR policy review, CSR committee composition, average net profit and CSR expenditure, CSR spending details, unspent amount reasons, CSR committee responsibility statement and disclosures. These are the 8 aspects which has to be mentioned in the Rule 8. So what is these aspects? This information should be there in the annual CSR report. Let's see first one. CSR policy overview. The brief outline of the CSR policy should be there. For which activities CSR should be spent and what are the ongoing projects for the CSR purpose all these aspects should be there. Then CSR committee composition, details of the members of the CSR committee, whether 3 directors will be there or not, out of which 1 independent director will be there. So all these requirements are there. So if it is all there, then what are the details of the directors? Then average net profit, the net profit for the last 3 financial years, because it will be useful for the calculation of the minimum CSR amount. What is the minimum CSR amount? 2% of the last 3 average profits, average net profits. Then CSR expenditure. What is the prescribed CSR expenditure? 2% of the average profit, right? So the calculated CSR expenditure should be mentioned. Then CSR spending details. What is the total spent? What is the total amount spent during the year? What is the unspent amount? And the breaking down of the amount for the specified format. So for which activity amount has to be spent. So we have to give breakup for the different activities. Then unspent amount regions. So we are unable to spend few amount. So minimum requirement is 2%. So I spend only 1.7%. Remaining 0.3% I am unable to spend. I need to give the details why I am unable to spend this amount. Then CSR committee responsibility statement. So a statement confirming that the implementation and monitoring of the CSR policy align with the company's CSR objective. So there should be CSR committee responsibility statement. In that all the committee should be giving confession that the implementation and monitoring of CSR policy lies with the CSR committee responsibility. Then what is the disclosure? The CSR policy contents must be disclosed in the board's report on the company's website as per the attached annexures. So the CSR policy contents must be disclosed in the board reports and on the company's website. So these are the information as per rule 8. So these are the aspects should be read from the CSR reporting. Then go to sustainability reporting. So what is meant by sustainability reporting? In the modern era, sustainability reporting is a key goal for all organizations, business, NPOs and government alike. It involves making decisions that consider economic viability alongside environmental and social impacts. So often summarized as people, planet and profit. So what are the key aspects of this sustainability? Social sustainability, environmental and economic. So coming to social responsibility, the focus is on building positive relationships. Building on positive relationships with whom? Employees, customers and communities. By doing this, it has enhanced the reputation and support from the localates. Then environmental sustainability. So it addresses the resources usage and waste and emissions, often leading to cost reductions. So as a part of environmental sustainability, it should address the usage of resources, how much resources it has been used in the consumption and production process, and what are the wastes and emissions coming out of these factories. All these has to be addressed to the stakeholders. Then economic sustainability, the emphasis in efficiency and profitability. So first aspect is people, then planet, about the wastage of resources, emissions, that and all. Then about the profit, economic sustainability, emphasizes is on efficiency and profitability. Then sustainability reporting involves publicly disclosing an organization's economic, environmental and social impacts, helping assess their contributions to sustainability development. So it recognizes the interconnectedness of these factors and supporting long-term planning. Then this sustainable reporting helps organization to integrate sustainability into their strategies, manage impacts and improve governance. While they are drafting the strategies, they need to consider the sustainability of these factors. Then one aspect is there, global reporting initiative. This is very important. I am expecting this as a theory question. So, global reporting initiative. GRI is a leading framework for voluntary reporting on environmental and social performance by business and organizations worldwide. So what is the GRI? GRI is a legal framework for what? For voluntarily reporting of environmental and social performance by the business and organizations. Then it provides guidance and standards for sustainability reporting with materiality as a key principle. What is the key principle for the GRI? Materiality regarding with the guidance and standards. This means reports should cover topics important for reflecting an organization's economic, environment and social impacts and that influence the stakeholder decision. So mainly in this report, what are the topics they are going to be covered? Organization's economic, environment and social impacts. Because of this, stakeholders' decisions might influence because of this reporting. What is meant by GPR? Sorry, GRI. GRI is a global reporting initiative. It is a leading framework for voluntary reporting. It is not compulsory. It is a voluntary reporting on environment and social performance by the business. What are the benefits of sustainability reporting, or what are the advantages of sustainability reporting? So there are internal benefits and external benefits. So there is an MCQ regarding the external benefits also. Please go and refer the MCQ session also if you are not yet completed. Internal benefits. What are the internal benefits? Because of sustainability reporting, risk understanding and the performance link, long-term focus, efficiency gains, benchmarking. First one, risk understanding. Improve awareness of risk and opportunity. Because of this, we can understand our risks and we can analyze our opportunities available in the market. Then what is performance link? Strengthens the connection between financial and non-financial performance. Because of this reporting, we can connect the financial aspects and the non-financial effects. The effects between financial and non-financial performance. Then long-term focus encourages focus on the long-term management strategies and policies. Then efficiency gains. It streamlines the process, reduces cost and improves overall efficiency. Because of this reporting, it streamlines the every process and reduces the cost and improves the overall efficiency. Then come for benchmarking. Allows the performance assessment against laws, standards and voluntary initiatives. So for example, government is drafting one rule regarding the reporting for every 3 months about the emissions out of our factory. So the government rule is giving the report for every 3 months, but I am giving the report for every 1 month. As a part of my sustainability reporting, I am giving report for every 1 month. So this is a benchmark. So I am giving report for every 1 month, right? But the government is fixed for every 3 months, but I am giving frequently. So I am giving more. So I am maintaining more standards than the benchmark. So than the standards set by the government. Then what are the external benefits? These are the internal benefits. For the risk understanding, for the linkage of financial and non-financial, focusing on the long term and streamline the process and reduction of cost. And third one is we can assess the performance against the government rules and regulations. Then come to the external benefits. Impact litigation and reputation enhancement and the value perception. Impact mitigation means it helps to reduce environmental, social and government impacts. So it helps to reduce the negative impacts of environmental, social and governance impacts. Then come to reputation enhancement. It boosts brand loyalty and improves public perception. Because of the sustainability reporting, completely the brand loyalty should be increased, and that also the perception of the public towards our company is also changed. Then value perception enhance the overall value of the organization. Because of all these benefits, anyhow, the overall value of the organization has to be increased. Sustainability reporting not only contributes to positive financial and non-financial outcomes, but also fosters better governance, risk management, and improved stakeholder relationship. These are the uses of the sustainability reporting. Let's see, is there any other aspect regarding with the sustainable reporting? We covered sustainable reporting, meaning and advantages of sustainable reporting. So that's all. Then let's go to other concept. Triple bottom line reporting. So what is the next concept? Triple bottom line reporting. So TBL is a framework that measures a company's commitment to sustainability by evaluating three key areas. What are they? Profit, people, and planet. In TPL, it starts with profit, then go for people, then planet. In sustainability reporting, it starts with the people, then planet, third one is the profit in sustainability reporting. But in triple bottom line reporting, it starts with profit. What is profit? This refers to the financial health of the organization, including revenues, profits, the financial impact of organization, and the people. So it focuses on company's impact on employees and communities, and as well as the society. So it focuses on factors like labor practice, community engagement, and the social equality. And come for the planet, environmental performance. So this dimension assesses the ecological footprint of the company, looking at the resource use, waste management, and environment sustainability reports. So we can refer the same points for the sustainability reporting also, and we can use those points here also. So if you read anything, you can use interchangeably. Then come for 4P bottom line reporting. It is triple P, right? So there are 3 P's. Here, apart from these 3 P's, one more P is there, that is purpose. Profit, people, and planet is the same, but here one more P is the purpose. What is meant by purpose? Spiritual performance. In 4P bottom line, one more P is less, that is spiritual performance. And what is 4P bottom line reporting? This is also known as quadruple bottom line reporting. So is a framework. QBRL is a framework that evaluates companies' overall performance by considering not just financial success, but also its social, environmental, ethical impact, promoting accountability and sustainability. Here, triple bottom line is a framework that measures the company's commitment about the sustainability or about three factors. Here, it is also the framework. It evaluates the company's performance, not only just the financial aspect, but also social, environmental, and ethical impact. Ethical means here the purpose or spiritual performance. These 3 aspects can write it from the triple bottom line also. Let's read the 4th purpose. This aspect examines how business activities enhance personal and collective well-being, promoting values like love, joy, and connection with a higher purpose. So this is the 4th point. It will be useful in MCQs also. So what are the key areas of QBL reporting? Profit, people, planet, and purpose. In the purpose, we need to do the focus on well-being and promoting values like love, joy, and connection with a higher purpose. Importance of QBLR reporting. So it provides a comprehensive view of organization impacts and stakeholder engagement by addressing the needs and concerns of various stakeholders, and long-term sustainability, focusing on 4 dimensions, promotes sustainability business practices, helping organization adapt to changing societal expectations and environmental challenges. Then come for informed decision making. QBL reporting equips management with insights to make better strategic decisions that reflect the organization values and long-term goals. So there are 4 benefits: integrated reporting and stakeholder engagement and long-term sustainability, informed decision making. It will be useful for management. Long-term sustainability, the focus is on long-term goal. Stakeholder engagement, it continuously addressing the needs of the stakeholders and integrated reporting. It provides a comprehensive view. Then what are the benefits of 4P bottom line reporting? This aspect is also important. 4P bottom line reporting. Enhanced reputation and brand, securing a social license, attracting and retaining employees, improved access to the investors, and preferred supplier status. Enhanced reputation and brand. Because of these reporting, our brand should be increased. In the triple bottom line also, what is the uses? Our loyalty, brand loyalty, and our customer perception or public perception is changing because of sustainability reporting. So the same point we can use here. Secure a social license to operate. So gaining community support. So we are gaining lot of community support. If you are following 4P bottom line, then attracting and retaining employees. So companies that prioritize the social and environmental responsibility are more likely to attract and keep talented employees and boosting loyalty and reducing the employee turnover. Then improved access to the investors. More investors consider environmental and social factors in their decisions. While if they are going for any decision, the investing decision, the investor should take into consideration of environmental and social factors. So preferred supplier status. The effective communication on sustainability can differentiate a company in the market, helping it secure a preferred supplier status. So because of this reporting, everyone is prefer our supplies rather than our competitors. Then what are the prerequisites for the implementation of QBL reporting? If you wanted to implement the QBL in your organization, what are the requirements? So it should have senior leadership must be there. And implementation of QBL can be required significant resources. We need leader, we need the resources, and more one, we need full-hearted effort, not half-hearted effort. Then strategy for implementing QBL reporting. What are the key considerations while implementing the QBL reporting? So clearly define how QBL reporting will support and drive the company's strategic objectives. And resources and cost assessment, establish the necessary resources and budget required for effective implementation. Legal awareness and risk understanding. So before implementing QBL, we need to understand the risk and legal awareness, and we should assess our resources, and we should evaluate the cost and the role definition. So clearly define how QBL reporting will support and drive the company's strategic objectives. Then come for key challenges: awareness, understanding stakeholder requirement, and alignment and performance indicators. Company need to establish and measure the appropriate performance indicators. It is a key challenging. Alignment. So align the company's objectives with the risk management strategy is a difficult part. And understanding stakeholder requirements. Identifying the stakeholder requirement is a difficult part. And awareness. Companies needs to understand the relevant issues surrounding the QBL reporting. Then what is the next aspect? So we complete triple bottom line and quadruple then 4P bottom line also. And meaning and benefits of integrated reporting. Integrated reporting combines financial and non-financial information to explain how an organization's strategy, governance, and performance create value over time. So integrated reporting combines financial and non-financial information. Why? To explain how an organization strategy, governance, and performance create value over time. Then it aims to provide comprehensive view of value creation. Why integrated reporting is providing? To provide a comprehensive view of value creation process by considering environmental, social, and governance factors, E, S, and G. So ESG factors within the context of organization's external environment. So this is called integrated reporting. Here we are considering both financial and non-financial. In sustainability reporting, what is the framework? So what is the definition? Sustainability reporting is a framework in which we are considering the below aspects. What are the aspects? The sustainability reporting starts with people, then
planet. Then profit. Okay, then go to triple bottom line, in which it considers the three aspects. What are they? Three aspects means it starts with the profit, then go for planet, then go for people, then go for planet. So these are the three aspects in the triple bottom line. Come to 4P bottom line. It is a framework. It considers not only financial factors but also environmental and social factors. In integrated reporting, it is a framework in which it combines financial and non-financial information. These are the basic definitions of reportings. Then come to the objectives of the integrated reporting. So improve information quality and promote cohesive reporting, enhance accountability, support integrated thinking. This question is already asked in the previous exam questions. So higher objectives, integrated reporting objectives. Then establish reporting norms. So improving the information quality, right? So it enhances the clarity and quality of data provided to financial capital providers. So financial capital providers need the information, right? So about their returns. So integrated reporting provide the information. Then promote cohesive reporting, foster a unified approach that incorporates various reporting standards and addressing all factors affecting an organization value creation. So it incorporates various reporting standards. Then enhance accountability. So strengthen the accountability and understanding of diverse capitals, because in integrated reporting we are mentioning all the capitals. And support integrated thinking, encourage decision making and actions focused on sustainable value creation across short, medium and long term time frames. Then establish reporting norms. Aim for integrated reporting to become the standard practice in corporate communication, streamlining information and fulfilling stakeholder needs effectively. So then come for value creation process. Here our objective is value creation. So comprehensive view of value creation, right? So what is value creation process? Components. What are the components available in the value creation process? Capital and external environment, purpose, mission and vision, governance, risk and opportunities. So in this, the capital is very important because there are 6 types of capital. Financial capital, like normal capital. Financial capital means what are the capital in the balance sheet. And go for manufactured capital, like physical assets, machineries, factories, tools, inventories, all they are called manufactured capital. Intellectual capital means intellectual properties, copyrights, know-how, technicality, all these aspects. Human capital means the expertise persons, the known people, along with the motivations to innovate. The skilled people, simply saying. Social and relationship capital. The network and relationship with the communities is also treated as a capital. Then natural capital, all renewable and non-renewable environmental resources and process that provide goods or services. It's called natural capital. So that there are 6 types of capital. Financial capital, manufactured capital, intellectual capital, human capital, social and relationship capital and natural capital. Value creation process. We need to select the business model. After that, develop the resource allocation plan. Then convert inputs into outputs. Enhance capitals. But financial, human, intellectual, natural. One more thing is there. What was that? One more capital is called social and relationship capital. Then dynamic process. Continuously review and assess the value creation process. And timely adjustment, make necessary changes to optimize the value creation. So why we are discussing about value creation? I am discussing integrated reporting. In integrated reporting, it gives a comprehensive view of the value creation process. That's why I am discussing the value creation. So what is the value creation process? I am discussing the value creation aspects in this. What are the value creation aspects? Capitals,
strategies and resources, risk and opportunities, performance outlook. Then I am coming for the value creation process. In this, we will select the business model. After that, develop resource allocation plan. Then go for conversion of inputs into outputs. Then enhance the capitals. Then dynamic the process. Continuously, we need to review and assess the value creation process and timely adjustments. If there is any changes is required, we need to make necessary changes to optimize the value creation process. What are the guidelines for the integrated reporting? To enhance the consistency and comparability, IIRC recommends 7 key guidelines. How many guidelines? 7. How many capitals? 6. So 7 guidelines will be there. Strategic focus and future orientation and connectivity of info, stakeholder relationship, materiality, conciseness, reliability and completeness, consistency and comparability. So there are 3 C's: connectivity, completeness and consistency and comparability. So strategic focus and future orientation and connectivity of information, second one. Third one, with this connectivity we can get the relationship, stakeholder relationship. Okay, then go for materiality, conciseness and reliability and completeness, consistency and comparability. Just try to remember the side headings. Okay, then we can fill it somehow in the exam. What are the challenges to implement the integrated reporting? Issue of assurance, lack of global standards, lack of acceptable metrics. So issue of assurance, so uncertainty regarding who will provide assurance for integrated reports. So there is uncertainty regarding the providing of assurance with integrated reporting. Then lack of global standards. There is no internationally recognized standards for integrated reporting. Then lack of acceptable metrics. Difficulty in measuring and quantifying the non-financial metrics and integrating them with the financial performance due to lack of standardized metrics. There is no some benchmarks, there is no specific rules and regulations with regard to the non-financial metrics. Then we discussed integrated reporting also. Then we covered them: TBL, financial reporting, annual report, financial statements, board of directors report. We can write our own terms also. Annual report. Annual report is a comprehensive report provided by the company as per the Companies Act rules and regulations. After that, financial statement, you know that, and board of reports is also know that. We can write it in our own words, and is also past examination questions from 2016 syllabus. So this is not that much important, I think. I don't know exactly. So then 22 syllabus, IR objectives and CSR rule 8 is also covered. What is rule 8? What is rule 8 of CSR? As per the rule 8, 1 minute. Rule 8 describes about the what information should be there in the CSR report. What information? So the information regarding with the how much we spent for the CSR, what is the unspent amount, what is the formulation policy for the CSR rules and regulations, and what are the unspent amount and reasons for the unspent amount, and the details about the activities providing, and one more information will be there. One more statement should be attached, that is responsibility statement, CSR committee responsibility statements. All these aspects described as per rule 8. Okay, so what are the remaining concepts here? So we have covered everything, right? So benefits of integrated reporting and integrated reporting. So TBL, triple bottom line, XBRL, meaning and benefits of the reporting, IR objectives and CSR rule 8. So we covered each and every aspect of the past paper questions. So what are the remaining concepts? Let's see, is there ESG. So environmental, social and governance. See ESG definition. So ESG stands for environmental, social and governance, and encompasses criteria to evaluate company's performance based on 3 key areas. So environmental and governance, social and governance. Environmental means about natural resources usage, or what is how to manage the waste of the organization and emissions from the organizations. And social, about the relationship with the employees, their customers, their suppliers, with the local people, What are the governance? What is the hierarchy structure, and what are the rules and regulations, and about transparency and accountability? All these aspects coming under governance. What is the importance of ESG reporting? So impact on the shareholders value. Investors will demand the ESG reporting and environmental impact analysis. It will increase the stakeholder relationship and corporate governance insights. So we can write these aspects for the remaining reports also. So basically these are the main things we can substitute for other reportings also. And ESG criteria overview. So environment. So what are the factors here? Conservation of natural resources, climate change and carbon emission, air and water pollution, biodiversity, deforestation, energy efficiency, waste management and water scarcity. All these aspects coming under environmental. About water, air, biodiversity, deforestation, we can write it on our own words. Then go for social. Examines relationship with the stakeholders, covering people and relationships considerations, customer satisfaction, data protection, gender diversity and employee engagement. Then come for governance. Board composition, audit committee structure and the whistleblower protections. All these comes under governance. So I am picking only the terms which will be easy to remember. So board composition, audit committee structure and whistleblower protections. Then go for human resource reporting. In human resource reporting, serves as analytical tool that presents the data and matrix related to workforce of the organization. So employee information reports, how many employees are there, turnover rates, recruitment reports, how many we are recruited during the year. So what is the performance management reports? So the performance of each and every employee or each and every group, and compensation reports. What are the salaries or applies or bonuses to the each ones, and termination budgets and analysis, list of employees terminated during the specified time frame, and equal employment opportunity reports. Ensure unbiased employment practices concerning gender, race and age. So we are providing same employment opportunities to irrespective of gender, caste, creed, religion. Then the workplace safety reports cover employee grievance, compensation and safety related data. The people who are working in the hazardous environment situations, they should provide some safeties. So for example, if they're working in the chemical industry, they should provide some masks or something. If they are working in the mines, they should be equipped with caps or something. So all these kinds are related to workplace safety reports, whether all these has been in compliance with the rules and regulations provided by the government or not. Then value added statement, already we have discussed in the practical aspects. So there are two parts, the generation of value added and distribution of value added, you know it, right? So what are the uses? Alternative performance measure, productivity measures, resource allocation, employment engagement incentive and bonus schemes. This is the format and market value added. So interpretation of MVA results. If it is a positive MVA, indicates market values the company above the capital invested, suggests strong future performance expectations. If it becomes negative MVA, it indicates below the capital invested and potentially signals for the poor performance or negative growth aspects. One important concepts, quarterly earnings call. Quarterly earnings call. There is an MCQ regarding with this. What is quarterly earnings call? So an earnings call is a conference call where a company's management discusses its financial results for a specific quarter or year, typically of following a press release summarizing these results. So the earnings call is a conference call when a company management discusses its financial results. So what is the structure in this? Safe harbor statement, presentation of financial results, Q&A session. So these are become the structure in these becomes the part of the structure of quarterly earnings call. So what are they? Safe harbor statement, presentation of financial results, Q&A session. Because I am repeating it, there is an MCQ regarding with this. So warns participants that discussions may include forward-looking statements. Then come to second one, key executives, especially CEO and CFO. Q&A session. Participants can ask the questions about the financial results. Then we have discussed the extensible business reporting language. So what are the features and benefits of XBRL? Let's see into it. Clear definitions and testable business rules and multilingual support and strong software support. These are the features of XBRL. We can write it as a benefit as well, I think. So automated data processing, increased accuracy and efficiency, enhanced data review, improved reporting quality, and cost and time savings. Because of this, we can save our cost or time. Because of this, the every information can go automatically, right? So we can use the information effectively also. Because of that, our cost and time are saving. Then one more aspect is there, BRR and BRSR. No need to stress that much, but we just wanted to have a look on that. Where is it? Here. BRSR are there. It means Business Responsibility Sustainability Report. So BRSR means Business Responsibility Sustainable Report. BRR means Business Responsibility Report. So in BRR there are 9 principles. In BRSR also there are 9 principles only. So remember these points. This is enough. So we covered almost each and every aspect of recent developments in FR. So we covered practical aspects and theory aspects also. The topic name is Government Accounting in India. What is government accounting? Simply saying it's accounting treatment for the revenues and expenditures of the government. Before looking into this, let's have some analysis on the past papers. So question number 8A coming from the government accounting. So in June 24 and December 23, one question is coming from the government accounting for 5 marks. What are the concepts covered here? PAC objectives and constitution. PAC means Public Accounts Committee. Then role of Public Accounts Committee. Coming to 8B. From 8B also one 5 marks question is coming. So the concept is GASAP note, means Government Accounting Standard Advisory Board and its structure. And previous attempt there will be IGFRS 4. So Indian Government Financial Reporting System 4. So in each exam at least 10 marks are coming from the Government Accounting chapter. So from 2016 syllabus, these are the concepts asked in each and every exam. So GASAP and functions of C&AG, again they are asking GASAP, objectives of government accounting, objectives and constitution of the Public Accounts Committee. So this question is repeating in the 2022 syllabus also. And the difference between government accounting and commercial accounting, GASAP and types of funds. There are 3 types of funds, we will discuss it later. And I guess one difference between government accounting and commercial accounting. So this question is also repeating, difference between government accounting and commercial accounting. And the GASAP is repeating so many times. Then come to IGFRS 4. So in 2016 syllabus they are asking I guess 1. In 2024 syllabus, 22 syllabus they are asking IGFRS 2. Let's read both the aspects. Then we will start with GASAP. This is an important one. Who is GASAP? GASAP means Government Accounting Standards Advisory Board. So what is the functions of the GASAP? They are issuing the government accounting standards. The accounting standards are issued by the GASAP. And GASAP is constituted by the C&AG. So Comptroller and Auditor General of India. So what are the responsibilities of the GASAP here? Responsibilities of the GASAP are establish and improve standards of the government accounting and financial reporting. This is one of the responsibility. Coming to second one, to provide guidance in implementation of government accounting standards. So they are issuing the standards and they are giving the guidance also for the implementation of those standards. And third one, to consider significant areas. So GASAP is considering the what are the significant areas. And the fourth one, to improve the understanding of the government accounting to the normal people. So these are the four responsibilities of the GASAP board. And come to structure of the GASAP. How the GASAP is formed. So in GASAP, these are the members. So chairperson, financial commissioner, member of telecom commissioner, secretary, controller general of defense accounts or accounts, and additional or joint secretary, deputy governor, director general, president, and principal director in GASAP as a member secretary. These are all the members in the GASAP board. So chairperson, first chairperson, deputy controller and auditor general. So he is acting as a chairperson in the GASAP. Coming to financial commissioner of railways department. So in this committee, in this board, we are covering each and every department of the governments. Then financial commissioner of railways department, then member of telecom commissioner of telecom department, and secretary of postal department, and controller general of defense accounts and controller general of accounts. Then additional or joint secretary of Ministry of Finance of Government of India. Then deputy governor of RBI and director general of NCAER and ICAI president and ICMAI president. Then principal director in the GASAP as a member secretary. So these are the structure of the board. These are the responsibilities of the board. Then next topic. What is the next important topic? Next one is public accounts committee is very important. So let's have a look on that. Public accounts committee. So public accounts committee is there. Public account committee is comprised of selected members of parliament. So public accounts committee is composed of selected members of the parliament. Then the committee ensures appropriate funds are spent wisely for intended purpose while such government spending adhere to the parliamentary limits. The public accounts committee is checking whether these funds are used for the appropriate purpose. Then although the CAG audit government accounts, committee reviews the CAG reports on the revenue and expenditure of the government of India, ensuring parliamentary control over expenditure. So the committee reviews the CAG audit reports. Then public accounts committee consists of 22 members. So 15 from Lok Sabha and 7 from Rajya Sabha. And this present PAC serves as a joint committee of both the houses of parliament. There are two houses, Rajya Sabha and Lok Sabha. So it is a joint committee for both the houses. The Speaker of Lok Sabha appoints a chairman of Public Accounts Committee, and the ministries cannot be elected to be committee member if becomes a ministry. They are automatically choose to be a committee member. So if any ministry cannot become the member, so if any member becomes the ministry, then he automatically terminates from his committee membership. So this is for introduction of Public Accounts Committee. Then look for the role of Public Accounts Committee. Primary function, investigation, unauthorized expenditure and ministry spending oversight and public corporation scrutiny. So these are the roles of the Public Accounts Committee. What is the primary function? The main role of PAC is to examine the audit report of CAG after it is presented in the parliament. Then once it is CAG audit report is presented in the parliament, then PAC can examine that audit report. Second one, investigation. The CAG assists the PAC during its investigation of audit findings. If any audit findings are there, if they think that there is necessary of the audit corrections, they can go for audit investigations. While doing that investigations, CAG can support the PAC. Then unauthorized expenditure. The PAC examines the CAG reports to ensure that the government expenditures are authorized by the parliament and do not exceed the approved limits, highlighting any unauthorized spending. Then ministry spending oversight. The PAC ensures ministries spending according to the parliamentary grants, addressing issues like extravagances and lack of financial integrity, but does not question the government policy. They cannot question the government policy, but they can address the issues like lack of financial integrity, and if they are spending more than the parliamentary grant limits, and they can address these issues, but they cannot question the government policy. And public corporation scrutiny. The PAC also review the audit reports of public corporations. So the PAC has the power to review the audit reports of public corporations and examine their operations and pointing out the administrative weakness. This showing as both a financial and administrative control mechanism. So it can review the reports, it can examine the operations, it pointing out the administrative weakness. So these are the roles of the Public Accounts Committee. So these are the notes for the Public Accounts Committee. So these are short notes for the Public Accounts Committee. So if you want, you can have a look at from here. Primary function, examine the audit report. Investigation, investigate the audit findings. Unauthorized expenditure, ensure expenditures not exceed limit. Ministry spending oversight, ensure spending according to the grant. And public corporation scrutiny can review the audit reports of the public corporations. And public PAC will consist 22 members, 15 from Lok Sabha and 7 from Rajya Sabha. And Speaker of Lok Sabha appoints the chairman of PAC. The chairman should be from the opposition party for ensuring independence. And the ministries cannot become the member of the committee. If the member of the committee becomes a ministry, then he can terminate from the member of the committee. Then what is the next important topic? So these are the basic two important topics. Then we will have a look on each and every aspect. First, let's start with the features of the government accounting. What is meant by government accounting? The government accounting means the accounting system used in the government institution for the purpose of recording, classifying and summarizing the financial information relating to collection and utilization of public funds. It is also called public fund accounting. And come to the features of the government accounting. Specific system of accounting, reporting of utilization of public funds and double entry system and budget heads, budget regulations and government regulations, mode of transactions, and its fund based accounting, and there should be auditing also. So first feature, specific system of accounting. So it follows the specific system. It's not usual. So there are 6 types of functional classification of transactions. The transactions are classified into 6 types of financial classifications. So government accounting is complying this kind of accounting system. Second one, reporting of utilization of public funds. Government accounting is reporting each and every utilization of the public funds, and it follows the double entry system, not the single entry. Come to budget heads. The expenditures and the departments or under a different budget heads will be there for those. And budget regulations and government regulations, the government accounting should be in accordance with the budget regulations and government regulations. And come to mode of transactions. Mode of transaction should be through banks only. Then fund based accounting and auditing is there. There are 3 types of funds: consolidated fund, contingency fund and public accounts. Consolidated fund for the planned expenses and contingency fund for unplanned expenses. Then second aspect, objectives of government accounting. What are the objectives of government accounting? To provide reliable data and to record financial transaction to prepare financial statements and reports, and to avoid excess expenditure, to prevent misappropriation of government funds, to help in preparing the annual budget. So here, first data, then transaction, then statements, then avoid, prevent, and help. So these are the keywords. So to provide reliable data, to record financial transaction, to preparation of the financial statements and reports, then avoid. To avoid excess expenditure, prevent. To prevent misappropriation of funds, help. To help in preparation of budgets, annual budgets. Then come to general principles of government accounting. So classification of expenditure and based on budget, end products of the government accounting and period of accounts and cash basis of accounting and form of accounts. So the expenditures are classified sector wise, major heads and minor heads. And government accounting is based on the annual budget. So end products of the government accounting, what are the end products? Monthly accounts and annual accounts, which will be useful in analysis of the government expenditures and the revenues and the period of accounts. So the accounting period is 1st April to 31st March. It follows the cash basis of accounting, but except for the book adjustment, it follows accrual system. And form of accounts, there are 3 funds: consolidated fund, contingency fund, and public accounts. And these funds are maintained by the pay and accounts office. It's a separate department under the government. Then come to consolidated fund. The article 266(1). It is the largest fund of India. So all the taxes, incomes and loans taken by the government credited to this account. Then second point. So the expenditures of the government are incurred out of this fund only with the prior authorization of the parliament. All the incomes credited to this fund and all the expenditures should be incurred out of this fund only, but prior authorization of the parliament is necessary. Then go to public accounts. The article 266(2). And remittance and suspense account. This is also known as remittance and suspense accounts of India. So all the debts other than included in the consolidated funds credited to this accounts. So what is the credits for this account? All the debts other than included in the consolidated fund. So parliament authorization is not required for the payments out of public accounts. If you want to use any funds out of public accounts, parliament authorization is not required. For the consolidated fund, prior authorization of parliament is required. Then go to contingent fund. So contingent fund article number is 267. The contingent fund is also known as impressed account of India. So the minimum corpus amount should be the 500 crores. So this fund is held by the secretary on behalf of the president, and it is used for unexpected expenditure. Because if you want to incur any expenditure out of consolidated fund, parliament prior authorization is required. For example, suddenly there are floods in Kerala, right? So we cannot use we cannot take the prior authorization of the parliament for the utilization of that emergency situation, right? So in that cases, I can incur expenditures from the contingency fund of India. So prior authorization is not required, but post authorization of the parliament is required. Okay, next concept, comparison between government accounting and commercial accounting. So meaning, object on information, scope, budget, level of accounting, rules and provisions, auditing. Meaning, government accounting is followed by the government organization. The accounting followed by the government organization is called government accounting. The accounting followed by non-government organization is called commercial accounting. Object or information. It recording and reporting of utilization and position of the public funds. So the government accounting is emphasis on recording and reporting of utilization and position of the public funds. Position means closing balance of the public funds. So in commercial accounting, the emphasis is on profit and loss and financial position. Financial position means balance sheet. Then government accounting is more elaborate than the commercial accounting. Budget. Government accounting follows the government budgeting system. There is no need to follow in commercial accounting. level of accounting. Government accounting as central level and operating level of systems. But in this, there is no provision of central and operating levels in commercial accounting. Rules and provisions. Financial rules and provisions of the government. So, government accounting, while we are doing the government accounting, I need to comply with the financial rules and provisions of the government. In commercial accounting, I need to comply with the generally accepted accounting principles, that is known as GAAP. Auditing. Recognized department of the government. Government accounting should be audited by the one recognized department of the government. Here, commercial accounting is audited by the professional auditor as per the Companies Act. Then come to the concept of Comptroller and Auditor General of India. So Comptroller and Auditor General of India is an individual persons. They are not group of persons. So Article 148 to 151 of the Constitutions deals the issues regarding with the Comptroller and Auditor General of India. Who is appointed CAG? CAG is appointed by the President and the tenure is 6 years. He is the external auditor for the government-owned corporations and he can conduct the supplementary audit of the government companies. Government companies means greater than or equal to 15% is held by the state government or central government or both. If any company is subsidiary of government company, then it also becomes the government company. Then prepare and submit of accounts. So these are the rules of the CAG. CAG should prepare and submit accounts of the government of union and state government and union territory with the state legislature. But whom should he submit the accounts? In case of central government, the submission is made with the president. In case of state, governor. In case of union territory with state legislature, administrator. What are the union territories with the state legislatures? Like Delhi, Jammu and Kashmir. Then, what is another duty of CAG? He should compile and keeping of accounts. So these are the duties of there are two duties: prepare and submit of the accounts and compilation and keeping of the accounts. These are the duties of CAG. Then government accounting levels. Controller General of Accounts and Principal Accounts of Office and Field Pay and Accounts Office. Controller General of Accounts is the apex accounting body in the Government of India. What is the apex accounting body? Controller General of Accounts. What they are going to do? They are consolidation and reporting of fiscal budget on the monthly basis. So they will consolidate and reporting of the fiscal budget on monthly basis. Principal and Accounts Office, they will compile the accounts, and Field Pay and Accounts Office maintain the three funds of the Government of India. Then come to Public Accounts Committee. So the formation of the Public Accounts Committee, the PAC will consist of 22 members, 15 from Lok Sabha and 7 from Raj Sabha. So we already discussed this Public Accounts Committee. Then come to Government Accounting Standards. This is also has been discussed in the earlier. Then come to Government Accounting Standards. In Government Accounting Standards, in previous exam, one has been asking, and from the IFRS, 4 is asking. So we will discuss those standards briefly, and remaining we will have into look. Government accounting standards are there. So Indian government accounting standards are there, and Indian government financial reporting standards are there. There are two types of standards: Indian government accounting standards and Indian government financial reporting standards, IGAS and IGFRS. There are 1, 2, 3, 7, 9, 10. There are 6 IGAS standards and there are 5 IGFRS. So why there are two type of standards? IGAS is used for the cash system of accounting and IGFRS are used for the accrual system of accounting while doing the accounting of the government. Then we will start with IGAS 1. guarantees given by the government and disclosures requirements. So I guess one name is guarantees given by the government and disclosures requirements. What are the disclosures under I guess one? So maximum amount of, what are the maximum amount of the guarantees, and what are the guarantees invoked during the year, and what are the commissions paying for giving the guarantees. So these all elements should be disclosed. So I guess one is important, right? So let's have a look from the concept book. So I guess one, the objective of this standard is to set out the disclosure norms in respect of guarantees given by the union, state government and union territories in their respective financial statements to ensure uniform and complete disclosure of such guarantee. Then this standard is applies to preparation of the statement of guarantees for the inclusion and presentation in the financial statements of governments. And third one, the accounting authority is responsible for the inclusions and the presentation of the statement of guarantees. The fourth one, disclosures. The financial statements of the union government, state government and union territory with state legislature shall disclose the details of all the guarantees given. Then come to I guess 2. The I guess 2 name is accounting and classification of grants in aid. So it deals with the accounting and classifications of the grants in aid. Third one, loans and advances made by the government. So what are the disclosures under I guess 3? So we should disclose the summary of loans and advances, group wise, sector wise repayment of the arrears, and we should disclose the detailed statement of loans and advances of group wise, sector wise and the repayment of arrears of central government and the state government. So we can write almost 6 or 7 points with this info. So disclosure of summary of loans and advances, group wise, sector wise and repayment arrears, 1 point. Second point, detailed statement of loans and advances, group wise, sector wise and repayment arrears. So there are 2 points. 2 points for the central government and 2 points for the state government. Same points you can write it down. So we can have the 4 points. That's enough. If they are asking about anything in the respect with I guess 3. So we should remember the standard name, loans and advances made by the government. Then 7. Foreign currency transactions and loans or gain by the exchange rate variation is the name of I guess 7. Foreign currency transactions and loans or gain by the exchange rate variation. Then what are the disclosures under I guess 7? Loans outstanding at historical cost at the beginning and ending, and loans outstanding at the closing rate at the beginning and ending. Then second point, loans outstanding in foreign currency at the beginning and ending. And what are the additions and what are the current rate and exchange gain or loss with regard to the foreign currency transactions. These are the disclosure requirements. Then I guess 9, government investments in equity. Government investments in equity. The disclosures are, we should disclose the detailed statements of investments and disinvestments. We can provide the summary of the investments, and we will provide additional disclosures of investee entities suffered a loss of 3 consecutive years. If any investee entity is there, if they suffered a consecutive losses for 3 years, and we should report the additional disclosures with respect to such investee entity. Then I guess 10, public debt and other liabilities of the government disclosure requirements. What are the disclosure requirements under I guess 10? And what is the name of the I guess 10? Public debt and other liabilities of the government and disclosure requirements. So we should disclose opening balance and additions and discharges during the year, and closing balances and net change in the rupee terms for the internal debt, external debt and other obligations. We can write 3 points by using these matter. So opening balance, additions and discharges during the year, and closing balance and net charge in the rupee terms for the internal debt and for the external debt and for other obligations also. and we should report and we should disclose, we should give the disclosure regarding with the interest paid and received details also. Come to IGFRS 1. IGFRS 1, presentation of the financial statements. It provides the manner and presentation of the financial statements. IGFRS 2, PPE, property, plant and equipment. So it deals with the recognition of PPE, carrying amount of PPE, and depreciation treatment of PPE and impairment loss. So same account, the concept are the same as like India 16. So IGFRS 3, revenue from the government exchange transactions. Revenue from government exchange transactions. And the fourth one, IGFRS 4, it deals with the inventories. So cost formulas, revenues and expenses. I will have a brief discussion with IGFRS 4 because it has been asked in the past exam. IGFRS 4, inventories. This standard provides guidance on the determination of cost and its subsequent recognition as an expenses. It gives a guidance for the determination of cost and subsequent recognition as expenses, including any write down to the net realizable value. So we should mention any write down to the net realizable value. Then it also provides guidance on the cost formulas that are used in assigning the cost to the inventories. And third one, this standard aims at using accrual principle of accounting for inventories. So this standard is aims at using accrual principles of accounting for the inventories, both at the stage of charging as expenses and depicting the closing stock in the financial statements at the end of the reporting period. So it provides the guidance about the cost formulas, about the determination of the cost, and about the accrual principles of accounting for the inventories at the stage of charging expenses and at the stage of valuing of closing stock. Then IGFRS 5. So the standard name is contingent liabilities other than guarantees and contingent assets disclosures requirements. So here the points are IGFRS 5. This standard has laid down the principles for the disclosure requirements of contingent liabilities, contingent assets for both the union and the state government, including union territories with the legislature in the respective financial statements, in order to ensure uniform and appropriate disclosure of such liabilities and assets. Then second point, the purpose of this standard is provide disclosure requirements of contingent liabilities and contingent assets of the government in the financial statements. They're continuously mentioning the words contingent liabilities and contingent assets and disclosure requirements. It laid down the principles for those disclosure requirements, and the purpose of this standard is to provide the disclosure requirements. Okay, then